Good morning, everyone. It gives me great pleasure to welcome you all here today to the Clayton Hotel, Cork, for our annual conference in association with VBC. It's wonderful to see so many familiar faces in the room and also to welcome those of you who are joining us for the first time. Whether you're a business owner, advisor, policymaker, or supporter of the SME community, your presence today is what makes this event so valuable. This year's theme is Navigation Tomorrow, Finance, Sustainability and Strategy for Irish SMEs. And I think we'll all agree it couldn't be more timely. Irish SMEs are the heartbeat of our economy. Every day they innovate, employ and adapt. But the pace of the change in the world around us, from financial pressures and evolving technologies to ever-growing importance of sustainability, means we need to continually step back and ask, are we ready for what's next? That's what today is all about, is a chance to reflect, to learn and more importantly, to connect. We've gathered a truly exceptional lineup of speakers, leaders in finance, sustainability, strategy and innovation. Each of them brings something different to the table, and I've no doubt that you'll leave here today with valuable insights, practical tools, and maybe a few new ideas you hadn't considered before. We'll be exploring the current financial landscape and what's ahead for SMEs, diving into the role sustainability must play in future growth, and looking at strategic approaches to help businesses not just survive, but thrive. These are real challenges, but they're also real opportunities. So I encourage you to engage today, ask questions, share your experience, network with fellow attendees, and take advantage of the wealth of knowledge that's in this room. Once again, thank you for being here. I hope you enjoy the day and come away inspired, informed, and ready to navigate tomorrow. Before we begin, it would be remiss of me not to mention the untimely passing of a great friend, John Mullins. John was a proud Cork man. He was larger-than-life character, and we shared many great times together. My thoughts are with his wife, Siobhan, his two children, Michael and Sarah, and the extended Mullins family. Arieste Gorevana. I'd like to introduce you to Siobhan Gibson, who's going to be your compere for the morning. Enjoy your morning. Thank you.
Good morning, everyone, and thank you all for joining us. So our first speaker this morning is John Finn, Managing Director of Treasury Solutions Ltd. John will take us through the banking and treasury outlook in a volatile world. Treasury Solutions Ltd provide debt advisory and corporate treasury management services. John has been involved in structuring debt and risk management deals totaling over 10 billion since he founded the company in 2001. Thank you, John. Thanks, John.
Okay. Morning, folks. This is just the world we're in is moving very quickly. The slides were sent at, I think, 3:15 yesterday, so that means they're probably out of date already when it comes to currencies and interest rates. I've got 35 minutes and a good few slides to get through, so if you're not awake, you probably will be in 40 minutes, probably because I'm going to scare you. We're going to cover a number of different topics. Going to start with the macroeconomic overview. I'll only cover a couple of things there because Jim is going to talk about that in a lot of detail in his speech. We'll then move on to foreign exchange, interest rates. We'll speak very quickly about funding developments. Again, I'm only going to touch on it tangentially because we have a panel discussion subsequently to me talking about other sources of funding, which I think is going to be very important going forward. There's one slide in sustainability, not because it's decreasing in importance, but again, I think Jim will have stuff to say on that, and then we'll just try and wrap it up, okay? So, what we're going to do is, while the slides are coming up, don't worry about that, I'll talk anyway. The macroeconomic overview. So first we're going to look at global trends. I'm not going to spend 30 minutes talking about Trump and tariffs and stuff, but if you just look at where we are in a broad sense at the minute, economies are generally slowing down. So GDP, most recent GDP readings were 0 in the EU, 0.1% in the UK, 2.4% in the States, and 3.7% here. Unemployment generally, globally, is pretty good, between 4 and 6%, so that's okay. Inflation coming down, but still not necessarily under control. For example, it's still 3.5% in the UK. But the debt to GDP is one of the things I want to focus on. I've been going on about this now for a couple of years, the debt levels in particular and the deficits, because the debt to GDP in Ireland, if we actually use GNI, is about 72%, okay? It's about 63% in Germany, it's 95% in the UK, and it's 122% in the States. Their debt is 122% of GDP and has been growing just massively over the last number of years. And again, we'll cover that in a second. And of course, then the knock-on effect in all this is that when you have high levels of debt, your interest costs are obviously higher. And then if interest rates are going higher on top of those interest costs, you get a compounding effect almost there. If we're looking forward, because PMI readings, they're the sort of things that look forward as opposed to GDP and unemployment have been lagging indicators. A reading of anything in the PMIs above 50 says expansion. A reading below 50 is contraction. EU manufacturing PMI at the minute is 48, so it's contracting. The figure in the UK is just under 45. It's about 50-ish in the States, and they're the most recent readings. I suspect they'll be worse when we get the readings in the next month or two, because consumer confidence is falling as well. And if you think about GDP, if any of you did economics in either for Leaving Cert or for college, you know, it's consumption plus investment, government spending plus exports minus imports, okay? Consumption is people spending money, and if consumer confidence is falling, that means that's going to ease back. Investment, we know so many multinationals and companies are holding back on investment now because of the uncertainty, okay? So that's falling. Government spending is probably going to have to rise, partly because of defence issues and stuff like that in Europe, and partly because of infrastructure. It's probably, we haven't spent enough in infrastructure over the last number of years as well. But then you have the debt issue there, how much can they borrow? So you can see of the variables in GDP, a lot of them are under pressure now, which would tend to point to an economic slowdown in general. And if you think about just deficits for a second, the States has basically run a deficit. So what I mean a deficit is you look at your tax revenues here, your revenues, and you have your expenditures, okay? So if your revenues exceed your expenditures, you've got a surplus. If you spend more as a government, then you actually you have a deficit. The economic theory is that you should run deficits when economies slow down. Why? Because governments need to spend more then, and also because obviously their tax take falls and their social welfare payments and things rise, okay? But then it should flip the other way when economies go well, because your tax take should be high and you shouldn't have to spend as much on things like social welfare. The States have been running a deficit since 2002, consistently from 2002 to 2024, okay? And just to give you an idea of the scale of their debt, their US government debt in 2000 was 5.8 trillion. In 2010 it was 14 trillion. In 2020 it was 27.7 trillion. And in 2024 it was 36 trillion, okay? So basically, if you run a deficit every year, the only way you can fund it is to borrow. It's like you earning 30 grand and spending 40 grand a year. You're borrowing 10 grand a year. And eventually, you know, can this keep going? Now, they've been able to get away with it because the dollar obviously is reserve currency. They can print dollars, and that's basically how they fund it. They print dollars to fund their deficit. But you would have seen interest rates, gilt interest rates, rise significantly in the States in the last couple of weeks. And for the first time, analysts are saying there's a political risk premium in interest rates, okay? Now, political risk premium normally arises in emerging markets. Why? Because they could be coming out of dictatorships or military coups or something like that. But you're actually seeing 45, 50 basis point rise in 30-year yields in the States. And this is the black swan event, potentially. Their debt is enormous. And I guess saying things like Trump threatened a couple of weeks ago, because a lot of their debt is maturing. They have a big wall of debt maturing in the next couple of years, and the same in the private sector as well. He has suggested, and at one stage I think he said, do we owe this money? Not a great thing to say because it spooks the markets. And somewhere along the way he also suggested they might do a debt swap. In other words, if you've got debt maturing the next 2 years, you might swap it for bonds instead for 20 or 30 years. Now, if you do that, you'll get away with it once, but you won't get away with it again. And an awful lot of the holders of US government gilts are foreign. Japanese are the largest holders, the Chinese are the next biggest holders, and quite a lot held in Europe as well, okay? So you can only fund your deficit if people buy your bonds. And this is where some of the tariff stuff might play out as well, because if you don't have, if people from, for example, from China or from Japan or from Europe decide not to buy bonds, you have a failed bond auction. If you fail bond auction, you have a major problem, okay? So that's the thing I think we're going to have to watch in particular. In Ireland, just one thing to note, and again, it's very important. We've been running a surplus for a number of years, but we've had, as you know, there's been a lot of talk about the one-off tax take from the multinationals and that. Department of Finance issued a publication last October for the budget, and they noted that we had a surplus, if you include the Apple money, of about 22 billion last year. But if you strip off what they call the non-recurring, or I'm going to call them the supernormal profits, and what is the actual level of deficit or surplus, they're actually saying we had a deficit of 6 billion last year. And in 2025, they're projecting an actual surplus of 9 billion, because that's what we think we'll get from corporation tax. But the underlying position, if you take that one-off stuff, is again a deficit of 5.7. So we have the Department of Finance are effectively saying, yes, we're throwing off cash, but in actual fact, that cash is not sustainable. And if you strip that out of it, we're actually running out of deficit. So you can see there are challenges all around in that regard. And the last thing, I suppose, on the government gilts and stuff like that is just to put again in perspective. The States, Germany spends 1% of its GDP on its interest costs because its debt is relatively low and interest rates are low. The UK spends 2.9% of its GDP on interest costs. The States already spends 4.7%. They spend, I think, or they will spend as much this year on interest as they will on defence, okay? So this debt mound that's there is a massive problem. It's a huge problem. But the problem is if it goes wrong for the world globally as well. So it's a particularly sobering thought. So in summary, macroeconomically, what we're saying is economies are slowing. Demographics, I guess, in the Western world are going the wrong way. Birth rates are falling and populations are aging. Poor growth in the UK, for example. I think in Ireland, look, first of all, I think the macro stuff is good, but we have a lot of money to spend on infrastructure. We do have a lot of revenues that are one-off in nature. And we've got challenges, I said, on a number of different spaces. UK growth was only 3.4% between 2019 and 2024. They also have government debt, as I said, at 95%. They've got challenges over there too. Productivity is quite low. I mean, we know what the problem is with the States. And I think the key issue for the States and the key problem for them is that the damage that he could do, even if he does a deal on the tariffs, and he is a wheeler and dealer, the trust and confidence thing is the big problem. Because confidence is hard won and easily lost. And I think that's going to be the big challenge for him. So the outlook right now is, the tariffs need to get sorted because it's not great. And again, one final little bit of trivia, as it were. China manufactures more than the States, Japan, Germany, and South Korea put together. Okay? So, if they don't sell to the States, they've got to sell somewhere else. And in actual fact, 70%, I think, of the economy in the States is based on services anyway. So, it's a mad situation that we're in at the moment. I hope it settles down. But it would be crystal ball gazing in this scenario is impossible. But generally right now, you'd say we're in risk-off mode. Economies are slowing. And I think we just, from a financial perspective, we just have to tighten our belts and monitor things more carefully, okay? Moving on to interest rates. So, in general, interest rates, as you know, have been falling for the last while. We have had, so the base rate peaked at, base deposit rate, ECB base deposit rate peaked at 4%. It's down to 2.5%. There's a ECB meeting again this week, and it will, I think it'll be cut. It's almost nailed on. It'll be cut to 2.25. Now, initially at the start of the year, we thought it might bottom out at 2%, but now it looks like we could have 3 or 4 cuts. So the current view is that the ECB rates, we have movement. We have, great. I've done all right, haven't I? In fairness, though, without the slides. Okay, I'm not going to go back over the graphs, but we can send the slides around afterwards, Paul, can't we? That's the States one, just there, the deficit. Okay, that gives you an idea. In fact, their deficit in 2024, outside of COVID, was the largest it's ever been. It's mad. Like when you think about it, you wouldn't run a G8 club like that in some respects. Okay, maybe you would. I shouldn't say that. I've been involved in some GA stuff myself over the years. I better say nothing. They're the gilt rates. I'm going to quick move on because we've covered that. Okay, on the interest rates, I needed this. Thanks be to God. Right. This is basically saying what the interest rates are from 1 up to 40 years at the minute. So we've got euros, sterling, and dollar. The key thing to note is, so when you're looking at interest rates, basically, if you draw a line or a curve from the short term to the long term, most of the time the curve goes upwards from left to right, okay? In other words, shorter term interest rates should be lower than longer term rates. When that happens, that's what we call a normal curve. In maybe about 12 months ago, it was going the other way. In other words, rates were coming down, so interest rates in the short end were actually higher than at the lower end. This is kind of normal service resuming of sorts, which is telling you that we're coming to the bottom of an interest rate cycle in the next 12 months, and therefore you'd expect things to maybe increase slightly again. If I move on to this one here, so this is the 3-month Euribor, okay? And Euribor is, it's basically, this follows the ECB base rate, okay? So the ECB obviously only move in chunks because they only meet, they don't even meet 12 times a year. And actual fact, although we're here in April, ECB only has 6 meetings left this year, okay? So there are only 6 opportunities of which to cut, and I think I said they'll cut between 3 and 4 times. You can see the Euribor rate, because that gets reset every day, that's at just over 2.25%. Why? Because we've been meeting this week and they're expected to cut from 2.5 to 2.25. So you can see the trend on the bottom here is the negative rates that were persisted for the last part, or for the latter half of the last decade. We got the climb here after COVID, and now it's easing back again. And this is what you call, I guess, a normal curve, bottoming out somewhere between 1.5 and 1.75%. The swap rate, so don't worry about the terminology. Swap rate is just if you wanted to fix in the markets for 3 years before any margins. This is the interbank level. You can see that's a lot choppier. That's only for this year. And what I wanted to highlight here was the volatility, I guess, of it. The fact that so the vertical lines here are the movements in the day, okay? So the small squiggles on each line is the opening and closing rates, all right? So you can see, and the reason why I put that in is I want to give you an idea of some of the volatility even within a day that's been happening in the markets in the last while, okay? So what you're basically seeing is the swap rate rose at the start of March, again in reaction to worries about uncertainty, Trump, etc. And I guess now because tariffs have been put, the fear that economies are slowing down, you got the swap rates coming back down again. And that's really the expectation that you're going to have contraction in GDP and therefore slowing economies and therefore swap rates coming down as a result, okay? On the outlook for the 3 different base rates, as I said, ECB, I think, will bottom out somewhere between 1.5 and 1.75 this year. That would have been envisaged to be 2% at the start of the year, but I said they're focusing on extra cuts now because of what's happening in the States. Similar, really, in the UK, at the start of the year, they're expecting 2 base rate cuts. The base rate's 4.5%. They're now talking of up to 4 cuts in the UK. The States, you're getting a mix of views, okay? So there's certainly some people saying you need to cut because the economy will slow. You have others saying that these tariffs, if you come through them, it's going to drive inflation up significantly. And if it drives inflation up, the Fed is going to have to hike. So the debate now is, do this hold steady for a longer period of time or not? So very hard to predict what might happen in the States simply because of the volatility and the unknown element of the tariffs, okay? But for us in Euroland, you'd expect short-term rates to come down again, which is good news for businesses in general, variable rate debt, mortgage holders, etc. Okay? I'm watching the time here because I am racing through this because I'm trying to get as much information to you as I can, all right? Okay, we're going to just look at 2 currencies, euro sterling and euro dollar. First of all, this is the 10-year trend in euro sterling, and you can see, so basically 2016 is Brexit, okay? Now, Paul's invited me back here because the first gig we did was in the end of January 2016, and basically what was happening is this volatility for the vote was coming in June. The uncertainty was a 50-50 vote. It wasn't priced into sterling. Sterling was at 72p at the time, and I said that morning, this is going to 80p by June. It was at 80p by March. And Paul said, sure, you can do this every year, come back and just tell us what's going to happen. He sets the bar very high is all I'm going to say to you. But you can see that, you know, you had literally sterling was at 72, 73p, hit 85p very quickly, and went higher. And we can see we're in a channel here now. Since about 2020, channel is narrowing, but kind of between 81 and 87p. It's holding at the minute. Touched against it recently, but came back down. I think we'll see where this will go. I think myself that that the movements, and you'll see in a second, have been very rapid, and that channel I think should hold for a while, because you could say nowhere is going well in the next while, because if the States slows, Europe slows, UK slows, everywhere slows. But that channel is key. A breakout, and at the minute more likely to be above 87. That's where that will be a significant move in sterling. And the dollar, if I look at the dollar, This is the year-to-date one again. You can see the movement that's been there so quickly. I mean, we've gone from 83p to 86.5 in the space of about a week, 10 days. It's a massive move. If you're an exporter to the UK, like that's a big dent to your profits if you have a hedge position. You know, that's an enormous move. And actually, if you look at this one, oops, are we gone again? It doesn't matter. I have looked at the highs and lows. So I look at the volatility every year as well as the averages. Here we go. Oh, let me get this again. Oops, sorry, go back to that one. There we go. Right. What I'm showing here quickly is the highs, lows, the difference between the highs and lows. So that gives you an idea of the volatility every year and the average for the years. What you'll note here is that we've had the volatility in quarter one has been as high as the volatility in all of 23 or all of 24. So it's already more volatile in that context, okay? And the average rate, I think, has been very good last year, the last 12, 18 months for exporters to the UK. I think we're not going to get that rate this year. I think we will be seeing higher levels, okay? So we want to watch that. So I'll come back to, the outlook for sterling very quickly said I think the sterling range will hold for now. The markets, though, are focused on government debt. And this is a funny thing. Markets focus on different things at different points in time. I remember working in the IFSC back in the early 90s, and government debt was the thing. They all focused on government debt. And then they moved to something else. It's a kind of a lemming mentality. But I think if they focus on government debt again, the States is in trouble, the dollar's in trouble, and so is sterling, if that's where the markets go, because their government debt is so much higher than other parts of the world. On the dollar, if you look at dollar, the euro dollar, again, much more volatile actually than euro sterling, just to note, okay? The high-low movement in, we just get this, hold on, come back here for a second. There we go. Let's just look at that's the trend for the last 20 years, okay? I suppose what I just wanted to say here is come back quickly. What I wanted to say here was that, you know, we're at 113, 114. Comparatively speaking, like we've had dollar up at 140, 150, okay? So the idea that it's been quite a narrow range, well, narrowish range of 1 to 120 for the last number of years. It has capacity to go to at least 120 and further, I guess is what I'm saying. And we've already seen it move 12, 13% in 3 months, okay? So it's a lot more volatile because of, again, what's happening in the States. And I think if we look at where the currency outlook is for it, I'd say, you know, a weaker dollar is probably good for US exports if you think about it, because it makes imports more expensive. It would be bad for us exporting to the States. Also bad for tourism here. Remember that, because we've had a lot of American tourists over the last number of years. They're literally getting great bang for their buck. If you see the dollar moving 15, 20% weaker against the euro, their spending capacity decreases. Therefore, you'd expect tourism business to decrease as well, okay? Weaker dollar tends to be good for energy because oil is priced in energy. Oil prices have come down from about $80 a barrel at the start of the year to $64 a barrel in the last few days again. So again, there's some positive news at least there. Price of oil is coming down and the price of it in euros is coming down with a weaker dollar. The key thing here is, for the first time, is the role of the dollar globally as the reserve currency has been spoken about for the first time ever, okay? And if the dollar was to not have that role, it has severe implications for the States, but probably has a knock-on effect globally as well. So what I would say is that in that context, the role of the Fed is also crucial. You've seen Trump has come out trying to put pressure on the Fed to cut rates, and they're supposed to be independent. And the other thing is that the Fed has always stepped in globally. Central banks globally have coordinated together when they have when crises like COVID and that. If we were to have another crisis and the Fed decided not to cooperate, you know, with the ECB, with the Bank of England, Bank of Japan, etc., there will be other implications again. Thank you, Paul. It's only water. It's nothing stronger. I might be having that afterwards. The Cork Wine Society, I think, is next door or something. Thanks, Paul. So again, I think the dollar could go to 120 and beyond. At the minute, there's so much uncertainty there, and just markets don't like uncertainty. So I think there's a risk that it can go further, okay? Again, predicting currencies is hard at the best of times. In the current environment, it's virtually impossible because it's not economics that's driving it now, it's politics. And the politics is driving the economics, which is driving the markets. And given that we have a political situation where it does appear that I won't say it's been made up as we go along, but it's quite volatile and quite uncertain, that makes that whole scenario. But the one thing I can generally say is currency markets don't like uncertainty. And that's why you've seen a sell-off in the dollar already. And I think you could see more sell-off in the dollar if they don't sort out their tariffs, okay? If I move on then to funding developments, and again, I'm only going to speak a couple of slides on this. We have a panel discussion on funding after this, and they'll cover that sort of stuff in a lot more detail. But again, just to give you maybe a couple of figures, I have a slide that I used certainly when we started talking about the financial crisis first, showing the level of debt, corporate debt in the market, okay? So central bank data, this is, it's widely available. You can get it yourself. You can check it up if you want to. Obviously, you have a better life than I have because this sort of stuff I do check. Clearly, you're not that boring or that bored with life. But I can tell you that the level of debt in the corporate market was about 30 billion-ish at the turn of the century, 2000, okay? It hit 160 billion by 2008, of which about 100 billion was property related, okay? The same figure for corporates now, this is Irish corporates only, so Irish corporates, whether operating here or abroad, it's not companies operating here in Ireland, okay? So purely Irish corporates. The level of debt at the minute is down to 35 billion. So think about that, we had 160 billion borrowed in 2008, it's down to 35 billion now. And that's back to about 2001, 2002 levels. And if you adjust for GDP, adjust for inflation, you could argue we're back to probably late 1990s level of borrowing. Now, in one sense, that's good, because obviously companies are not indebted anything like they used to be. I would argue that that's too low. You need a certain level of investment in the economy, and I would worry that the effects of the financial crisis are still permeating today, and as a result, companies are only funding almost what they can fund themselves out of their own resources and funding a certain amount with debt. But I think there could be an argument made that we've underinvested at this stage, and that shows that it's underinvested. And if we just look at the SME part of that as well, if you take the level of debt in 2010, so post-crisis has been 100, it's 42 today, okay? So it's less than half again. So it's across the board, across all sectors, the level of debt is diminished dramatically. And that will be seen then in the bank's balance sheets, okay? So I had a quick look at the bank's balance sheets yesterday. At the end of 2024, AIB, I think, had 69 billion in loans outstanding, 109 billion in deposits, okay? And they were the other way around in 2008. They had to borrow in the interbank market, all the banks, because their deposit base was so low. Bank of Ireland had 83 billion in loans and 103 billion in deposits, okay? And PTSB had, I think, 24 billion in deposits and 21 billion in loans. So every one of the banks have more deposits than loans. And I said it's the complete opposite of where we were in 2008. So their credit ratings are good here. The three banks they're much better than they were, and they're solid. Their capital ratios are good. In the banking sector, the problem is it's too small. Okay, but they're in what's there is in great shape. All right. The lack of competition it could be a challenge, and I think even privately they will admit that themselves, because competition is good for us all. It drives us on. The other challenges in this space, I guess, is that, I suppose, credit. Risk departments are really calling the shots more and more, and credit departments seem to be risk off rather than risk on. So the level of leverage generally that they want to lend against is low anyway. You can see a push towards automation. I would argue that automation of bank lending practices is not a good idea. And the reason why I say it is because anybody who in banking over the years will tell you lend as much to the person as the company. In other words, if you want to come in and you want to make a loan application, I could argue we could make the numbers work, but the question is, does the story stand up? And quite often the story has been told by somebody who drives a business, and quite often from talking to that person whether they know the business, they know the sector, they're committed to it. You can't get that across on a spreadsheet. So I have a very firm view that lending is part science and part art. Okay. The science bit is cranking the numbers. The art bit is, do they make sense, and are they in the right sectors, and do people really, can they drive the business? A move to automation of sorts using AI, which I think is coming for loans. I think we could see this sort of automatic, the computer says yes or no stuff for loans of up to $1 million in the next 2 or 3 years potentially. I don't think that's a good development. I can see it's a cost-efficient development from a banking perspective, but I don't think it's a good development in general. The other thing too, I guess, and the banks are also, they're still subject to a lot of regulation, an awful lot of regulation, and regulations continuing to increase. And Willie Madden's going to fall off his chair, because I have a lot of sympathy for the lending people, despite spending 25 years negotiating with them. It's a hard it's a hard job in a bank now, because they've cut back resources, They're definitely under-resourced in lending, I think, across the board, driven by cost considerations. As I said, credit are calling the shots. And if you think about it even at macro level within the bank, if you have more deposits than you have loans, I mean, literally, if you can pay 1% on deposits and put it on deposit with ECB for 2.5%, you make it 1.5%, no risk, no capital allocation, easy money. And then you're going in as a lending person and you're going to, you look for a margin of 3 or whatever it is, 3.5%. There is risk, there is capital allocated, and you're fighting against that other deposit thing. It's not an easy situation to be in. So it's and that's where I think the non-bank sector and the private credit market have a gap to fill, and I think that gap will continue to grow, quite frankly, which is why the next session I think is going to be equally important, because in a market where we have only 3 banks, that non-bank bit becomes more important, okay? And as I said, so overall, I think what I would say to people on the borrowing side is start early. It's taken longer, okay? It is taking longer, so if you need money in 3 months' time, start now. Don't start thinking about it in 6 weeks' time. The quality of the information is very important. The ability to, I suppose, share information. See, you got to understand at the end of the day, a credit process works like this. You have to give information to a relationship person in a bank who sells your story on your behalf to the credit committee. The more information they have, the better informed they have, the more likely you're going to get a positive result. So the idea of not telling them stuff doesn't work. It doesn't work for you, never mind for them, okay? So you do have to focus on relationships. They are worth investing in, and as I said, at the end of the day, bankers want to lend because they don't make money and they don't survive, they don't lend. But I think that bit of linking in, sharing information, and I suppose good quality information is important, okay? One thing on sustainability, I've only one slide. Picture it in your head. It says 3 points. One is drive on or row back. Sustainability has kind of come on the agenda, come off the agenda. Jim's going to talk about it, I know, in a lot more detail. A lot of it was driven by CSRD, so the requirement to report on sustainability. EU has rolled back on that in the last number of weeks, okay? They've had an omnibus package, which is basically scaling back the reporting requirements. If they scale it back, then does that mean the pressure comes off? So the key thing is, did people see sustainability as a compliance issue or as a strategic issue, okay? And if you see it as a compliance issue, people will come back from it. If they see it as a strategic issue, they'll keep going. For SMEs, where you still got to watch it is if you're part of a supply chain and somebody in supply chain has CSRD or other sustainability requirements, they're probably going to demand of you. So therefore, you may not have a compliance per se in a legal sense, but you will have a compliance issue in a commercial sense. So again, you need to find out if someone in your supply chain that's crucial is likely to come back. Practical implications, finally, to me, the obvious ones are insurance straight away, okay? The banks did a mapping, I know Bank of Ireland 2 or 3 years ago in their annual report, did a mapping exercise of Ireland and the UK for flood risk, okay? Because obviously if you can't get insurance, you probably won't get a loan for a house or a building. And actually, if you have it now, and your insurance suddenly disappears in 2 or 3 or 4 years' time because suddenly there's a flood risk or whatever, now you have a bigger problem because you've got a loan and you've got no insurance. If you have no insurance, you have a default under your bank agreement. Because every single bank agreement has an insurance clause that says you must have your insurance up to date. I did a sustainability course at the Institute one, the certificate one, just there at the start of the year. And there was a model on UCC, and they modelled Cork and Dublin for a relatively modest increase in sea levels and how it changes the landscape. And it's quite frightening, to be honest with you. As I said, if I'd had more time, I would have put 1 or 2 slides and that sort of stuff. But we do have to start thinking about, insurance in particular, infrastructure, all that sort of stuff. Sustainability is going to have an impact on us one way or the other. And I suppose the challenge now is to think, how do we link it into our business and make, because it's not just coming down the tracks from a compliance perspective or from a best practice perspective, it's going to bite. And I think the insurance space is probably the area where it's going to bite. So the last summary, I think I'm doing okay at time, it's only just about 35 minutes. So summary, status of the UK or US is changing. We have a new world trading order. Basically the norms that have persisted since World War II are now been broken. Okay? And what does the new world order look like? We don't know. I mean, does America sort of have a North American and South American kind of aspect to life and worry about that and leave Europe here and leave China dominating over here? I don't know. I mean, he seems to have it in for China more than anybody else because he's doubled the tariffs there again when he's rolled back on everybody else. But it just seems that it's a state of flux, and I said I'm sure Jim will talk about it in a lot more detail. But it has, if it changes in the States, it's going to change for everybody because their global role is enormous, and B, the interconnected nature of global trade is such that if they change things there, it has to have a knock-on effect on us. The base rate in the Eurozone, I think, will be cut at least 3 times in 2025. Sorry, 3 more times, possibly 4, depending. Foreign exchange volatility, I think, is going to persist, mainly driven by political uncertainty. And I think foreign exchange is always the funny one, because as I said to you, it's impossible to predict, but it's also probably the most volatile piece of our P&L, okay? Because literally the price of FX moves every minute of every day. And I think it's still the most undermanaged part of finance, to be honest with you. Because most companies here either import or export, one way or the other. And we're indirectly exposed to foreign exchange through the price of oil, through the price of commodities, all that sort of stuff. So it has a way bigger impact, I think, than some people think. The bottom line on currency hedging for everyone here is, look, you're never going to beat the market, okay? Everybody wants to know, is sterling going up or going down? Where do you think it's going? There's traders who have 6 or 7 or 8 screens in front of them who trade currencies every day. And think about it, for every winner, there's a loser. Yeah? So 50% of the traders in the world and all the investment banks are not making money. So why, we making widgets think we can do better is madness. Focus on your margins, okay? I'm sitting on a board of one company. We put an FX policy in place because we have fairly big exposure to euro sterling, and it's very simple. Our gross margin is what's very important because we're buying stuff in the Eurozone and selling it in the UK. So the key thing is managing our gross margin, because if we manage our gross margin, our overheads generally we can control, we can hit our EBITDA numbers, okay? So forget about beating the market. What's the FX rate that you need to beat, okay? What's your target benchmark rate? And just hedge around that. Don't worry about, because the arguments I've had over the years about, you're after selling sterling at 85 and now it's 82. If we'd done no hedging, we would have been better off. Yeah, that's great telling me now, but you should have told me that 6 months ago when we were going to hedge. Nobody knows, now what's going to happen in 6 months' time. In 6 months' time, everyone will tell you they all knew the dollar was going to 120 or back to parity, yeah? So don't try and beat the market. Just keep it simple, protect your margins, but have a process in place, okay, on currency. Bank lending, in summary, I said it's veering towards risk off. Loan applications will take longer. They do have to lend, but you will have to work with them a bit better. I'm certainly noticing a lot more questions coming back, and I think that's because it's coming back from credit and risk people again in the bank. But as I said to you, the quality of your information, the quality of your preparedness will be very important. And as I said, our next panel, I'm sure, will share some light as well on the alternatives that are out there and what options you have. The key, in general, though, on a macro level, economic slowdown does look likely because of all that's happening, because of confidence, because of, I said, everything just been put off. Investments on hold, consumer spending holding back. I saw even yesterday, I think on RT, they were saying that the holiday bookings are way down. People are holding off at the minute booking even this year. That's just consumer confidence again, not sure, okay? And for me, the US government debt is the black swan, okay? Did anybody ever read the book, The Black Swan? No? Somebody told me, somebody said years ago, you should read that, you'd love it. It's financial markets and it's philosophy and it's great. I brought it on holidays. We were sitting down the first day by the pool and freaking, and my wife says, how's your book? I said, I need a highlighter for starters. I said, I need to read it about twice. She said, why? I said, I'm on holidays. And I said, yeah, in theory it's interesting, but your man is trying to disprove how a normal distribution curve doesn't apply to tail risk in financial markets. That's not really reading for holidays. But basically the theory of the black swan is that, there are 1 in 30-year events and they have a small chance of happening, but if they happen, their impact is enormous. Now, of course, the problem is the interconnected nature of the world shows the 1 in 30-year events now seem to be 1 in 10, 1 in 5-year events for starters. And secondly, as I said, if they happen, it's big. And as I said, I have been going on about the US government debt for 2 or 3 years because it just doesn't make sense to me. And I think it is the black swan. If it goes wrong, it will go wrong very badly. But if it goes badly wrong for them, it's going to go badly wrong for everybody. So hopefully some sense will prevail. And, we'll come back next year, Paul, and things will be on the up again. So I'm glad you enjoyed my talk. And the slides will be available afterwards. But I think I've explained pretty much all that I need to explain. So I'll take questions. Well, I think I'm over on time, so I'll take questions if you want, or otherwise I'm going to be hanging around after it. So, but thank you for your attention. Okay.
Just a quick question, John. John. Can you hear me? Yeah.
Yep.
I couldn't agree more with what you're saying in terms of prudence around managing foreign exchange risk and protecting your margin. And I'm just curious, obviously I did that back in the day, advising companies. And I remember always quoting a stat that 96% of the volumes of FX traded daily are speculative. Only 4% relate to trade. And you said yourself there that it's politics and economics that are driving the volatility. But is speculation, I mean, we think about the likes of George Soros back in the day and big players that were actually moving the market. Mm-hmm. Is that, I'm a bit disconnected from it on a day-to-day basis, is that still a factor?
It is huge. And the thing is, dealers, which you're talking about when you say speculating, I mean, they're dealers in investment banks, global investment banks, where they trade currency, so they look to make money. They love volatility. They don't make money when you have quiet times. They only make money in volatile times. But by definition, then, that almost encourages volatility because you get bigger bets, you know, in and out. So it's happening, and it almost becomes a compounding effect, because if you have political uncertainty, that drives the markets, you know, a bit madder in the first instance. And then if you then have the traders then now are going to be trading more because they see opportunities. But I think it's statistic, it might be 90-10 or something like that, but I think the last time I saw it, it's still of that nature. Yeah, the trading bit. And sorry, the other thing I should say to you too is that, you know, most companies don't have a policy in terms of foreign exchange and treasury in general. If policy is just a couple of pages, you should do it because it puts structures. Because what it does, particularly if any of you here are CFOs, you have two reasons for doing it. Number one, it's best practice and you should, and it gives you guidance as a CFO as opposed to guessing what a board might like. Secondly, it covers your backside in case something goes wrong. Now, I prefer if you did it for the first reason rather than the second. But also remember, for boards, anybody who's on a board here, like, you are responsible for risk. You have a legal responsibility to manage the risk. And you know, that's part of a fundamental part of risk. So having a policy in this space, it's not about, you don't need a huge policy. Just sit down. Most of you are probably doing the right things anyway, okay? It's just a matter of documenting it. And it's funny, when you put stuff down on paper and you actually probe it a little bit, you always find, why are we doing that? Why are we not doing that? You get a better outcome. But I mean, it's a good idea to have discussion around it, because I said you can't second guess markets in terms of interest rates and foreign exchange, but you need to cover off liquidity. Make sure that you have access to money when you need it. Make sure that you manage your debt and your loan documentation and your loan processes. But again, I would say 15% of companies who are turning over 20, 30 million up probably only have a policy in place. 85% don't. And I don't understand why. Particularly if I was a CFO, I'd want one. If I was a non-exec, I'd certainly want one, because I'm as responsible as the executive directors, and I don't have the same access to information. So that's, again, another thing that it's a simple thing, but it should be done. I'm just conscious of the time because I don't want to eat into the next panel's time. Look, I'll hang around afterwards if anybody wants to ask any questions, if that's okay. But there's a couple of really good sessions coming up, and I certainly don't want to delay them from coming on any longer. Okay, thank you.
Now, thank you, John. That was very informative. I'm really, really glad Paul invited you back. So well done also on facing the technology challenge. And sorry about that, guys. There's a bit of a connection issue in the room. So big apologies, and well done, John. It wasn't easy. So next up is our finance panel, who will discuss recent shifts in private investment, the funding avenues available for Irish SMEs, and what's needed to get investment ready. They are Helen Cahill, the co-founder and CEO of Finance Fair, who has facilitated over $2 billion in funding for scaling businesses. Mark Flood, who co-founded Renatus, a private equity firm investing in ambitious Irish and UK companies. And Alan O'Dea, a director at Beechbrook Capital, responsible for investments across Ireland, the UK, and Northern Europe. Brendan Lenihan, managing director of Navigo Consulting, joins our panel today as our host and facilitator. Please join me in welcoming them all.
Thanks, Siobhan, and thanks to Paul for the invitation. And just to echo Paul's comments about John Mullins, he'll be sadly missed. But just to link to John Finn's presentation, I guess there's a great alleged Chinese proverb, which is, it's better to wear slippers than to try to carpet the world. So in many ways, you can look at everything that's going on in the world, and John has explained it really, really well, as he always does. At the level of your individual firm, what do you do in terms of the economic reality? What do you do in terms of funding? And when I started my career back in the early 90s, there were not a lot of options, actually, to be fair, in terms of how you funded the world. And in many ways, people saw cash and money as the destination. Now people think of it as a raw material. You got to source it well, you got to buy it well, it's got to come in the right quality, and it's got to be productive for you, because it's a really important raw material to get you to your destination. So I'm really honoured to be joined this morning by three folks here who have a lot to say about alternative ways of funding your business. Ways that wouldn't have existed actually in the early 90s, it's fair to say, or certainly not very prominent in Ireland. And I'm keen to just probe with them what it might mean for businesses like your own. But one question to start to each of them, which is, are you open for business? I mean, there have been times in the cycle when financiers and people who control money have just decided to shut up shop. The world is too volatile, so much going on, we're just not giving out money. So for each of these three representatives on the panel of this sector, I just want to start with that quick question. Are you open for business right now with everything that's going on in the world? Helen?
I just received an email before I stood up from Rob Horgan, who I met yesterday from Velo Coffee in Cork Chamber, and he said, look, Helen, best of luck in the panel. Just start off by saying to everybody, we're here to give you money. So Finance Fair was born out of the turbulence and the dysfunctionality after the global financial crisis. So we're used to, as John alluded to, traditional providers and banks tend to go risk off when there's a lot of uncertainty and volatility. We have a very deep lending pool, funding pool, and also our model is all based around receivables, which themselves are slightly uncorrelated. They don't behave the same way. So our funding is deep, it's very sticky, and we're very much here.
That's a yes, yeah. Alan?
Big yes.
How about you?
Yeah, I think, look, the last week obviously has been last 2 weeks incredibly volatile. Markets are swinging up and down by 5 or 6% every day, but I think the one thing we are certain about is that ultimately they will normalise, they will rebound, because ultimately it's driven by human behaviour. And I think the four key words that are lethal in financial markets are different, because it's not. Ultimately, people who navigate the situation, address the risks. And I know John obviously mentioned black swan events. I think COVID absolutely counts as a black swan event. And what the Irish Entrepreneurial Network demonstrated over the last 5 years is their ability to be resilient, adaptive, navigate the new situation. And we've been in operation since 2008, so we've experienced multiple market disruptive events. But throughout that period, we've remained consistently delivering capital, factoring in obviously each unique risk with each market cycle. But I think from an investor perspective, you do need to have that long-term view. You do need to be consistent.
Okay, that's a yes. And Mark?
Yeah, very much open for business. As they say, a boat is safe at harbour, but that's not what a boat is supposed to do. So we have a fund that we need to deploy, and we're very open. We had a 10 million fund, 3 investments, 40 million, 6 investments, and we have a 60 million fund. But what I would say is that there are questions at investment committee level to like 2 big questions. Anything on the food and pharma food chain? What is the effect in an extreme situation? If there's great companies, when you think of what's around Little Island and Ballybrit and Galway and different places that are on that food chain, and we have been involved in a few, but that is a big question. And the other question is, if we are at the top of the cycle, what did this kind of business look like post global financial crisis? And okay. So we're open but careful.
Yeah, yes, but yes, and. Okay, I'm going to ask the guys in a minute to just describe what it is they do and give you 1 or 2 practical examples of how that's worked for companies. But actually before that, when we get on a call, we just put together, Helen very kindly put together for us 1 slide, which is about the funding journey. If you can pull it up here, and we can, the life cycle of the funding journey. I have it here, Helen, if you want to speak to it. And we might talk about that, and And then I'll ask the guys where they fit in and what it is they do with some practical examples. So, Helen, do you want to chat us through this?
Yeah, I mean, this isn't reflective of everybody's funding journey in the audience, I'm sure. But a typical funding journey starts off with somebody having an idea, and they go and get funding for that. And we know in Ireland there's a huge ecosystem, meetups, accelerators. Enterprise Ireland are a driving force, whether it's their competitive startup fund, their HPSU, the Leos are very good. So there's a lot there. However, what we're seeing is that once companies have that well has dried up, that there then is a significant funding gap when it comes to the next stage of their growth. And I suppose that's where we play. And if a company has revenue and is growing revenues, our model unlocks growth funding from their revenues. And we serve companies at different stages of their growth. So we'd advance up to 250 for some stage, up to 750, and then others will advance up from 750 to 3 million. And companies have journeyed with us. So we don't provide term funding, but we provide growth funding. And there are companies that we've been funding for the last 5-8 years, all around receivables.
Okay. Great, all around receivables and working capital, essentially.
Exactly.
Yeah, and Alan, where do you fit on this slide to the extent you can categorise yourself?
Yeah, so if you look at I suppose after the kind of Series A, B, C, and D, we're kind of at that stage where companies reached a level of profitability. Our loans typically start at kind of 4 to 5 million and can go anywhere up to 20 to 30 million. So businesses are usually, their product is commercialised. They're at that stage where they're now seeking capital. We kind of described as, I suppose, transformative capital, because you're using it as a catalyst for that next leg of growth. You're typically going to be generating EBITDA in the range of kind of 1.5, 2 million upwards. And that's kind of the area we fit in terms of sectors. We're quite agnostic. It is really much focused on the growth opportunity. We're not restrictive in terms of how it can be used, whether it could be for organic growth, whether that's boots on the ground, investment in CapEx, or if inorganic, if you're making an acquisition. Routinely what we see is shareholders in a business realigning the cap table, and that ultimately does provide a catalyst for future growth. But one important point, and it's important for companies to understand, is I suppose you shouldn't view us as being mutually exclusive either. We support companies, private equity-backed companies. We have one company where we actually refinanced out finance fair. And we have situations where we're working alongside them as well. So it is quite beneficial for companies to know that there is multiple options available. But in terms of the specific parameters, that's where Beechbrook fits in.
Okay, thanks, Helen. And Mark, where are you? What's your sweet spot, I guess?
We're two from the bottom, PE, private equity. We are equity, so we take shares of businesses. It's not a coupon on our money. So we do, of 9 of our current businesses, Helen and Finance Fair back too. So we coexist together there, and Alan and David and Beechbrook guys, we've collaborated a lot in a sense over and back, so we'll be disappointed if we don't do something over coming years together. But we are equity. There's probably 3 situations where equity plays a part. One is where somebody is exiting their shareholding. The second is where somebody wants to chip off we call it monetize success. Other people call it de-risk. But they've been on a journey, and a lot of our transactions have been where people had offers from trade, and we decided to say, well, how about you take half off and we'll roll half and we'll go on a journey. And it's just been amazing for the psychology for people as well, because they get to kind of bear the fruits of success, and then they're probably a little bit more going for it when they've got the money in the personal account, and they can really go for the growth. And the third is then when there's money needed for, in particular, acquisitions or capital investment within it. So there are 3 scenarios where equity makes sense.
And sticking with that, Mark, just do you have 1 or 2 practical examples to the extent you can share with us of how that has worked for businesses you've helped?
Yeah, probably CRS is a good case study. It was 2 brothers took over their dad's business, and they were in a lot of different facets of refrigeration, but they really focused in on taking a ship container and turning it into a modular refrigeration or freezing unit and leasing it to food and pharma. And that business, they were on the cusp of selling it, and they decided to sell 40%, and it trebled in 4 years. And we brought a lot of things to the table to them. You know, we brought a really good finance structure, one of the traditional banks that allowed them scale, where before they were always kind of pulling in for petrol every 10 miles. So it just capitalised them for proper growth and got good people around, grew into the UK and Europe, and they've actually chipped off half again and gone with the new owners. So they've really monetized that along the way, and they just are so grateful for not selling 5 years ago when they could have sold 100%. You know. So really, what we bring along with equity is experience around and really get that strategy and org chart right, where we bring in the right people. But it's all about preserving the DNA of the business and bringing in some growth levers and getting the balance.
You're bringing some growth DNA in with you as well, I guess, and a raw material. Yeah, we okay with that?
Yeah.
Alan, some examples of where you've helped businesses?
Yeah, so maybe describe briefly the structure of our loans. They're non-amortizing, so you only service the interest, bullet repayment, usually after 5 or 6 years. And the reason we structure our loans like that is we want to support the growth in a business. We'd rather the cash flows being reinvested rather than paying down the principal. But in contrast then, where that works, I suppose, also to the benefit of the company, is during a period of volatility. One company we supported back in 2019, market fell away during COVID, but having that headroom with their cash flows allowed them to manage the crisis quite effectively, and they came out the other side, and the business has been performing extremely well since. Another business that we supported, we initially provided a loan back in 2018. It was an industrial engineering business that was to support an acquisition. And we stay close to the companies that we support. We're not obviously as close as private equity. We're not involved in the operational decision making or anything like that, but we receive monthly management information. We speak to the management teams regularly. And that company went on a journey, a buy and build journey, and needed quick decisions around acquisitions. And because we remained close to the company throughout that life, we were able to provide them the capital relatively quick and enabled them to make those acquisitions. And ultimately, at the end, we were refinanced out by a conventional banking source. And back to my earlier point, you know, we don't view ourselves as mutually exclusive. Everybody has a role to play within the funding ecosystem. And that company is a prime example of where we fit in on its growth journey, buy and build, and then ultimately being refinanced out when it reached a certain level of stability by a conventional banking source. So it's really playing in that area where you may not have a lot of collateral to mortgage, or, you know, it is true cash flow lending, and you are ultimately backing the owners and the managers of the business, because I think, look, all of us here are involved in SME investing, and if you expect the performance over a 5-year period to go in a diagonal straight line up and to the right of a graph, you're probably in the wrong business. So you are backing that management team not only to deliver on the growth, but to navigate a crisis as well that will inevitably happen throughout the period of that investment.
Well done. And Helen, some good war
yeah,
stories
we
here.
fund, I should say that we're sector agnostic, and we fund across all sectors. But there are some sectors, sadly, that are completely and utterly ignored. Technology would be one, e-commerce, SaaS, and particularly companies where they don't have tangible assets. So that's important to note. We're sector agnostic. We are receivables based, and to John's point, we don't automate our decision makings, but we do leverage technology. So we're able to reach in and see the sources of truth. It's very important that the audience understands how valuable that is in order for us to be able to advance and lend money where others can't, give it quickly and give more. An example of one local to us, and we met them yesterday, Aidan and Hilary from Autonomy. They're building, they've 400 people now. They are building and scaling a fully remote, tech-enabled CX company, where companies like Aura, for example, are engaging them to manage their business on an outserved, a modern version of an old call center. And the problem we're solving is that if you look at their balance sheet and where they are, it mightn't be bankable. We can fund their growth, and we can fund it where they have particular concentration within their customer mix, as all companies do. So Again, because our funding is different, it looks through a different lens, and it's all about the quality of the receivables. We're able to walk that path with them. Another example would be the likes of Tom Cotter in Ocean Ore, locally here in Cork as well, in the sustainable luxury apparel business, and has really strong recurring revenue with the resorts and the suppliers or the customers that he supplies into. And we have a mechanism for leveraging that strong, predictable, recurring revenue and funding their growth. And it may well be that at a point in time they need something different. They need an Alan or they need a Mark, and we might be taken off the pitch, but then we might be brought back onto the pitch to work alongside a senior debt funder or private equity or a VC. Why? We're the growth catalyst. We drive growth.
Okay, that's great. And to say the obvious, there are other sources of advice here as well. So Paul and his colleagues, for example, will advise on that growth journey. To kind of declare an interest here, I sit on the investment committee in Enterprise Ireland as part of one of my non-executive roles. So EI are a great resource to you if you're an EI client. They will also, this is a habitat where Ireland is a village. Everybody knows everybody else, and often people with that knowledge can provide you with some good leads in terms of sources of finance to think about. Now, I just want to get on to the practical question, I guess, of if there's somebody out here who wants to come and interact with you as organisations and benefit from some of the services and products that you have, what advice would you give them in terms of just preparing to interact with you, to get ready to deal with something that might be a novel source of finance? If my business already has been financed by my own cash flow, my own retained earnings, it's a terrific business, I maybe have a bank loan on a premises, but that's about it in terms of sophistication. How should I be mentally prepared and practically prepared before I come and engage with you? Mark, or Alan, sorry, I'm going to start with Alan on this particular one. What advice, practical advice, would you give me about starting to talk to you?
Well, in simple terms, get advice, right? And the reason I say that is because if you're talking about an investment from Beechbrook or Renatus or whoever it might be, you're talking in the millions. At least with us, it's 5 million, which is a material sum for an investment into an SME, and it's probably the first time that they're taking on board that level of investment. John referenced it earlier about information flow, and that is absolutely critical. We can move quickly if the information is available, but getting that information together is time consuming. It will take away from your daily operation, running the daily operations of the business, and that's something that ultimately you don't want the business to suffer for 3 or 4 months when you're running a transaction to bring in funding. So having proper advice on board, helping you prepare that information, it will pay for itself. But importantly as well, the market has evolved a lot over the last kind of 5 to 6 years. It's a lot more educated now in the alternative sources of capital. And from a borrower perspective, having that advice on board, you're going to be presented with a range of options. You may have only thought that there might be, 2 options available, but you're now dealing with somebody who's able to bring you a range of options, who's able to negotiate on your behalf, and ultimately find you the most optimal solution for your business. So it really is that simple. If you are talking about taking on board, 4 or 5 million plus of investment, having advice on board, it pays for itself 10 times over, in my opinion.
Sure. Mark, how do I get myself fit and ready to interact with you?
Yeah, I'd agree with everything Alan says and what you say. Look, a good advisor will help you matchmake. Who's like, take us, we'll do 2 deals a year. So if we, we're not going to. So an advisor will think what suits these different type of equity houses. There's probably a dozen brass plate equity houses around, and you've the pillar banks. They'll know what'll get there. So a good advisor will do the matchmaking. There's 2 parts to getting ready. One is getting to, call it, heads of terms, and the second is getting from heads of terms to an executed deal. So if you take those 2 work streams, getting to heads of terms is your story. Like, what will someone buy the story? So we always say it's a 3-page PDF. 1 page is your last 3 years. What have you done? 2nd page is your next 3 years, which encapsulates your strategy. And the 3rd is your org chart, your people. Getting that right is just so crucial, because that then will land on someone's desk and say, yeah, oh God, they've delivered well the last 3 years. I like that plan. They're going to double. and whoa, yeah, they're good people to do it. So that sounds easy, but it's so hard to get the right people in the right places, and that involves people at that point in time on the org chart who will sit in front of someone and say, I'm committed to this for the next 5 years. You know, you can have someone who's delivered the last 3 years' numbers, but they're thinking, they're looking at the door, and people will spot that on the way in. So that's the 3-page to get to heads of terms. But then from, say, that gets someone to say, I'd like to do a deal with you at this basis and this. But then from heads of terms to execution, and this is where your Paul and your advisors come in. It's just having your house in order, like having everything in order, your whole, if it's leases, if it's agreements, if it's everything that'll be asked in a due diligence, and you need someone looking around the corner, and you need to be preparing for that, you know, years in advance with a good advisor and a good CFO. But they're the two facets of it.
Yeah, and that was interesting. We were chatting earlier on about how the fact that you can't do much about the last 3 years, but you can tell the story. You can tell a story about the business you're in, the customers you have. But getting the strategy right for the next 3 years and getting the org chart right, they're just gold, really, aren't they? Helen, what's your advice?
I agree with the guys. I mean, we fund a lot of Enterprise Ireland companies, and we are kind of, the market is not short of ambition, companies that want to scale. My observation would be that there's probably an education gap around the range of choices that are available, number one. Number two, I think that people need to be much more selfish about what they have and being forensic. So that means, do I have a strong management team? Shine a light on it. Do I have a strong cap table? Shine a light on it. Who are my customers? Because certainly Finance Fair, we take a very forward-looking view in terms of our underwriting decisions. How am I going to grow my business? What business am I going to win? And the quality of dare I say again, the quality of those customers and those receivables, and being able to set that out clearly, along with, in our underwriting model, we attach huge importance to strong financial control. It's part of our scoring system. And when we engage with customers, we actually ingest information via technology, open banking and accounting. Having that information in order, and enables us to make really fast decisions to deliver solutions that are aligned to the growth that you're talking about at your own board tables. So I think that's being very selfish, really, about putting your best foot forward.
Yeah, I remember, Paul, you would remember back in the day when some of us were learning the ropes, we used to study Peter Drucker, who invented all these things: cost centers, profit centers, investment centers. And actually, I read recently, Peter Drucker said one thing recently. He said, well, not that recently, he said, I always regret inventing the term profit center, because there's only one profit center in a business: a customer whose check doesn't bounce. That's it. That is your profit center, actually, and the start and end of the business, the story of a lot of businesses, it is about its customers. You either serve them profitably or you don't. I just want to pick up and ask your views, actually, on one thing. John Finn made a really impressive presentation, but he gave numbers around the idea that we're seeing the effect still of the financial crisis in Ireland. Those of us who lived through it, we still have the scars on our back in lots of different ways. And he said, there's a big chance we're underinvested and we're undergeared, really, essentially. And the non-bank sector, and I guess you're kind of all in that broad category, maybe some more than others, is going to grow because we are underinvested and we have a lack of competition in banking. So, what's your view on all of that? Are we underinvested, undergeared as a business sector in Ireland at the moment?
I can just give an example through the lens of Beechbrook, I guess, since I suppose we made our first investment in the Irish market in 2018, and just a few anecdotal points, but at the time, I suppose getting out there, building our network, letting the market, educating the market about ourselves, there wasn't a lot of education about alternative credit as a source of capital, and I suppose when you're talking to the various advisors, there was a corporate finance head, and that was it, and they were responsible for M&A, for raising equity, raising debt. But what we've seen since 2008 and over the last number of years in particular is that a lot of the advisory network now in Ireland are building out dedicated debt advisory positions, which is reflective of the market. And I think while there is still a funding gap, I do believe that it has closed significantly over the last number of years. And that's probably been led by private equity. It was only a matter of time really before international private equity firms started coming to the Irish market, realising the potential of businesses here. Mark obviously has been doing it since 2013, I think. Yeah. But with that then private credit flows with private equity. So the market is maturing. There's still a lot of opportunities, but I think from a borrower perspective and companies in general, there is a lot more education out there now, and they're getting more comfortable with alternative credit as a source.
Yeah, so you're also endorsing what Helen is saying about that education gap, that information gap about what's out there, and how applicable it can be to businesses of any kind of substantial scale at all. Mark, what do you think? Are we, as an equity guy, do you think we're under-geared?
No, I think like we've met 2,000 companies since we started. I couldn't pinpoint, like we absolutely love businesses and meet lots and lots and lots. I couldn't pinpoint that business that's kind of so conservative they're not growing. When you look at the M&A deals, like every year we've been reporting them in newsletter, they're growing. And I think there's a lot of, so I couldn't pinpoint that business over there that if they got another turn of debt that they could be growing so faster. But there's also a dynamic where we have a big shift to services, and I think Ireland is really well positioned in the shift to services. If you think of, like, you can already see the spillover of the alumni from the old days of the digital in Galway, the GPA, that we can see it in tech. You can see it in a lot of tech, and you can see it in a lot of services. So like services don't necessarily, a lot of businesses that we look at, the constraint isn't the capital structure, it's the people and operational. Like we've one or two businesses that could borrow probably 3 times, but they operationally couldn't deal with doing another 4 acquisitions a year. So I think the constraint is less capital because there's so many variations of it, and it's more people in cases. So I accept what John says. It sticks out as a thing, but I don't see it in front of me.
Okay. I want to pick up any questions you have in a few moments, but I am just going to ask the panel first, so think of some really good questions. John also talked obviously about what's going on in the US and the idea that I think encapsulated in another, I think it's a Dutch proverb now, the Dutch have a proverb which says, trust arrives on foot and leaves on horseback. So you can spend 20 years building up trust, but as soon as you start to denigrate it, it just gallops away from you. What's your read on what's happening in the world now, particularly in the US, and where it's all going to end? Before I go to the audience for some pertinent questions. Anybody want to take that up? Any brave enough to take up?
I suppose we've 12 investments, 3 divested. Of the 9, 1 has a headwind and 1 has a tailwind, and the other 7 all have secondary exposure, which can't be underestimated at this stage. But that's one, just to give you like a dipstick of our world, like Renatus, we do car license plates, and we've 10 states in the US we've won, but the actual material for the car license plates, which ultimately goes into correctional industries, the prisons, that comes from China. So like we've a relatively modest margin, and we're being forced with it's when you take the original tariffs, it's getting up to 130% when it's all loaded in. That's just unsustainable. So I don't know, like, what do we do? Well, we're probably going to trade it for a month or 2 and see what happens, but you have to think it's unsustainable. And then the one that has the tailwind is a business that does construction tech into semiconductor and pharma, and we've set up base in the US, EIDA, IDA, and you have to think that there's going to be a lot more built. You hear Nvidia saying that that's where they want their chips built is the US. So one has a tailwind, one has a headwind, the rest have secondary exposure. And but it just seems too bad to be true that the Chinese thing can prevail.
Yeah, so in many cases, lots of Irish businesses have just secondary exposure, so there's a lot of that. And I heard someone recently say, a 10% tariff, it's a pricing discussion. At 20-25% tariff, you're reorganizing your supply chain big time. At 50% tariff, you're dead. and 150% tariff, you're still dead. It doesn't really matter where you go after 50%, really. Your margin is gone, essentially. Any other thoughts on the way the world is at the moment, guys?
I'd only add, without repeating what I said earlier, but like you can't make any material decisions now based on what's happening over the last 2 weeks, because as John made a point earlier, his slides changed numerous times in the last week, and I'm sure by the time we finish this, he'd be changing them again. So I think we really just have to ignore the noise to an extent, take a measured approach, but making ultimate decisions around tariffs at the moment, at Beechbrook anyway, with our portfolio companies, is just staying calm and waiting for everything to play out. But I think ultimately, we really do mean this, is that companies will adapt, whatever the situation will be, and you just have to keep moving forward.
Yeah, I mean, as part of our risk monitoring, obviously we looked at the portfolio and the impact, which is very minimal, but we'd be looking at factors that impact risk. For example, foreign exchange movements, tariffs, all these things. We did have one customer last week where we fund their software, but they also have hardware, and that's manufactured in Vietnam. They're selling into the US market. It's a low margin business in the telco space. Like that has just set off a bomb at their board table in terms of the go forward. The pause obviously is kind of paralysing, but so, I suppose from our point of view, we fund across all sectors, so we're going to have to dig into, because we're in the underwriting business, how this plays out in terms of how we will stitch that into our underwriting.
Yeah, so it's challenging a lot of boards, and that's where the steering, I guess, of the organisation happens. And having a board and having good steering is really important. Any questions from our audience for the Brains Trust here? Gentleman in the front here. Just give me a show of hands to show me how many questions are out there, by the way.
Great presentation. Thanks very much. Helen Cahill is my name. I'm curious, at least two of you were formed out of the last adversity of 2008, and so we managed to get this far without mentioning AI in any conversation, but obviously, where do we see the opportunity in the adversity to put some enlightenment in terms of what's happening, in terms of for across the business you might see right now?
Well, we use AI in our own business. I would have to say that we use it. So we have our own in-house technology team, and we obviously have a risk team. We have various different pillars within the business. And AI has supercharged our operational workflows. It has increased productivity. We're also looking at Gen AI in terms of how we can surface that for customers to try and make the complexity of what we do more easily understood. I don't see us maybe using AI to underwrite, but it'll help us use the data that we're ingesting to reach faster decisions, but we'll be the guardian of those decisions.
Yeah, our proudest AI play at the moment is in a company called Capture, where we are solving a big world problem, which is getting a quick pint at half time in a game. And we launched in Norwich 2 weeks ago, where we've got vision cameras in the ceiling. You tap, go through a turnstile, and the vision tech spots that it's you, your card. You take the pint, you walk out. We're putting through 200 pints with queues in this bar, and they put through 350 with no queues and half the staff. So we're Cork will be busy in Croke Park later in the summer. So we're going live in Croke Park, so you'll get to see it.
I think just across our portfolio at an operational level, it's been implemented across various sectors, but from an underwriting perspective, similar thoughts to Helen. I don't think ultimately it will be a deciding factor for us because, as I mentioned earlier, if you are investing in an SME, over a 5-6 year period, it is ultimately backing the owner, the management team. I'm not sure if we're there yet with AI in making that decision for you.
Thanks, great question, Ian. Gentleman in the front here.
Thank you. Jonathan Gray from Ovation Incentives. One of the funding paths that wasn't really talked about today was the public equity markets and their use for funding, particularly small to medium-sized enterprises. When you think of the last few years, the opportunity for sub-100 million turnover businesses to use the public equity markets has significantly declined, and the use of M&A and private exits has flourished. If you take the example of the AIM market in the UK, which was designed to fund such types of businesses. There was 1,500 companies on the AIM market a decade ago. Today, there are about 700. Is it the cost of public finance or public equity financing, the risk of it, or the fear, or the regulation that's driving the exit route for businesses to private equity and M&A rather than to the public markets, particularly for the smaller to medium-sized businesses?
Great question, Jonathan.
Yeah, I think it's. I think if we look at our hero companies in Ireland, we look at the, all around the Kerrys, the CRHs, the Paddy Powers, the DCCs, and all our we all grew up. They were the hero companies, and you can kind of plot the paths, the Ryanairs, the whole lot. You can plot them. I'm pretty convinced those same companies in today's market wouldn't be IPOing. Obviously, Apple Green is probably the most recent success story that has come through it, because there's such a plethora of options. There's such international, we're reporting on it every week in the newsletter. It's just the level of international private equity, and it's just take a Jimmy Martin in AMCS up in Limerick. That business is worth reported to be near 3 billion now. And the tech is on every bin truck in the world, and people don't realise it exists. And Jimmy's founder and still a significant shareholder, but he's got to 3 billion value. Someone's backed it because they think it'll get to 5, 6, 7. That's in your real IPO territory. But why would you show the world everything you're doing and have to report to analysts 3 months when you can do effectively with a handshake get private equity? And we're at the smaller enterprise values of 10 to 50 million, but there's such an ecosystem of global players at the biggest level. Pros and cons. What would you want to do at a bigger level? If you can do a handshake and have a relationship with someone who understands your business, it's probably a path of least resistance to do a deal with private equity. And at a lower level, there is, as I said, there's 10 dozen brass plates. There's ourselves, there's BGF, there's MML, there's Cardinal, there's Melior, there's Causeway, there's Foresight. There's such a plethora of options. If there's any gap, I think the bigger gap is on this on the EIS and getting people. The bigger gap is the kind of 1 million funding, because if you're looking for a few $100,000 and you're credible, you'll probably get it from friends and family. If you're looking for 3, 5 plus, there's a lot of brass plates and they're at critical mass to do it. I believe, I don't think they aim they tried, that Swedish stock exchange tried to do something and a couple messed around at it, but it wasn't. I think the bigger gap is at the 1 to 3 million for EIS, where someone can put their money in, get a tax break and give their experience as well. That's the bigger gap in an equity sense, because I don't think the public markets offer anything that the privates don't offer, really.
Okay, any other thoughts in the panel on that? Paula?
No, actually, Collect, refuse tech platform that we used to fund, were one of the players that went down that route of raising on the Swedish stock exchange. And from talking to the founders, I'm not saying it was a bad experience, but it does come with its obligations, and that was for a much smaller company. The question, we're not playing in that space per se, but we observe big players that are going down that route. You have the likes of the Klarnas. I do think Mark's point, though, around that EIS, again, it goes back to the funding gap. And just worth noting that, again, selfishly for any founders or business owners in the audience, there is a slight market failure or challenge at the moment with respect to raising equity in a certain ticket size. We're finding that companies are having to go back to their boards and they're not able to raise equity, and they're going back to existing shareholders asking them to put their hands in their pocket again. And sometimes they'll want to do that and sometimes they won't. And there are mechanisms, one of which we have, where existing shareholders can follow their money, underpin their investment, but do it at arm's length, where it's liquid, it's not subordinated, it doesn't disturb the cap table, and it enjoys the real-time monitoring and oversight that we do day in, day out. So again, that's an I'm sure nobody in the room knew that was an alternative. So it's about educating about how we bridge these gaps.
Yeah. Okay.
But we need a public market for the visibility of the country, for small to medium-sized enterprises to go public, to grow. Isn't it structurally important for our economy and for our nation and even for Europe to have a vibrant public market structure that does work?
It's a good question, because obviously it's all eyes on the concentration that FDI presents to the economy, and that our scaling middle, which is our addressable market, needs, it's a fair point, but I think the mindset of that cohort is they're not in that zone, would be my observation. I don't know what Alan and Mark think.
Yeah, I think it's an unfortunate byproduct if there's less, like all of our heroes, the Dennis Brosnans, the Michael Smurfett, the Stuart Kennys, the Michael O'Leary's, it's less played out in the public eye, which is unfortunate. But I think that's incumbent on events like this, and we've Jimmy Martin speaking at the Real Deal in Goffs in the end of May. I think we do need role models. The entrepreneurial ecosystem needs role models. It's unfortunate with that. It might be harder to put shares in people's hands, but it's still doable in a private thing. So there are pros and cons. But like if personally, if I was in a business being faced with IPOing at $1 billion value, or doing a handshake with someone that Jim Barry can put me in touch with, I'd prefer to do the handshake.
With a lot of due diligence now, Jim Barry put you in touch with them, to be fair. I'm only joking, Jim, only joking. So great question, Jonathan. There is a question there about how much the public market is really part of democratic society in many ways, and if it doesn't function, does it need to be reformed? And I'm sure Jim will talk later on, as John alluded to, about sustainability and climate. And one of the questions I asked recently was, some of you would have engaged with CSRD. How did it ever get that far? That public companies, for example, and moderately sized companies had a big target on their back that says, you'll just do all of this. Yeah, you'll just do loads of this. Like, a version of it could have worked, but maybe not everything that was envisioned for something that is really needed for the climate crisis. So it only remains to me to thank, actually, Alan and Mark and Helen for their wonderful contribution. I always say that talk is cheap because supply massively exceeds demand, okay? But in this case, in 45 minutes, I think the three here have covered a lot of ground at a very high level, and only tapped on the edge of their expertise in this. So there are alternatives available to you now in terms of raw material and funding of your business, and it's a journey that we'll see more and more in the years to come. So thanks to Paul for having the foresight of scheduling this as a topic, and I think Paul is going to speak to you again before the break. No? Well, I think Siobhan actually is. Put your hands together actually for the panels before.
So thank you to everyone, and thank you. That was an excellent panel discussion. Thanks to Helen, Mark, Alan, and Brendan, of course. So now, guys, it's time for some refreshments outside there in the hall, and we'll reconvene back here about 11 o'clock, half an hour. Thanks very much. Welcome back, everyone. Welcome back, everyone. Please now give a warm welcome to our keynote speaker, Senior Energy Transition Leader, Jim Barry. Jim joins us for a keynote talk on sustainability, seeing the big picture beyond today, and investing in challenging times. Jim has been a pioneer in this space for over 25 years. He was Chief Investment Officer of BlackRock's $330 billion alternative asset business, and is now spearheading the development of a global insurance carrier, developing risk solutions in the energy transition space. Thank you, Jim.
I had a huge presentation prepared, spent months at it, and unfortunately with the tech issues, I just wrote out a few points. So let me start by mentioning John Mullins as well. I had the great pleasure, and sometimes not pleasure, of working with John for a few years in the first part of the decade. unbelievably smart guy, and always high energy, huge commitment, and just fun to be around. And I have to be honest, it was with great dismay and regret I heard of his passing. I only saw him a few weeks ago, and I'm sure half the room probably only saw him a few weeks ago, because that was his nature. But a real Cork man. He bled Cork, no matter where on the planet he was, and I was in a few odd corners of the planet with him. But it just would be inappropriate just not to acknowledge him and the friendship this morning. Anyway, okay, what am I going to talk about? It's one of these things which I've done quite a bit, but you kind of don't know where to start at the moment. Steve Bannon, that right-wing populist in the United States, Irish heritage as it happens, talked about in Trump 45 flooding the zone with decisions. Well, the zone is flooded and increasingly flooded with the scale and scope of decision-making coming out of the United States. I also need to preface my subsequent remarks by saying I'm actually really great crack. I'm really good to have on a night out. Paul, please, wherever you are, he'll give evidence to this. But it just may not come across, okay, in the next 25, 45 minutes, whatever, with Q&A. So a couple of things. You have to start with the United States. And we listen to a lot of stuff. We're so more engaged in the economy in the last 20 years than in the previous 40 years in just natural dialogue. And we talk about big events and change. But I'm telling you, the world has now changed. So the environment that the global economy and global society has operated in since Second World War has now changed. And the United States, which was the cornerstone of stability over that 80 years in a rules-based global order, is now the major source of instability. And that changes everything. And so whatever you take out of today, you just got to take out that the world is now going to be a much more volatile, uncertain space, which gets down to what decision-making you take every day in your businesses. And I think that that's one of the reasons I'm bearish on both the US economy and the global economy, is that how do you take decisions as a consumer, as a corporate entity, as an investor? How do you take decisions in this environment? And I think that people are putting their hands in their pocket and not spending. I was in Goodwood at the weekend, a mate of mine, to see him crash his car in front of 20,000 people. But he was saying that the preppers of the cars who are working for generally high net worth individuals, their business is down 20-30%. Auction prices on vintage cars, again, reflecting a certain segment of society, down 20-30%. You're getting these little stories anecdotally all over the place of it. And what's worse is you're now seeing it in data. The big consumer sentiment data in the United States that's watched and respected over a long time is the Michigan Opinion Survey. And it's showing results that haven't been seen since the global financial crisis, or even 2001 in terms of unemployment expectations. Or sorry, 1981 on unemployment expectations. And their inflation expectations in the next 12 months is 6.7%, which is a good 200 basis points higher than it was even in the peak of 23-24. So what you're beginning to see is the consequence of this decision-making volatility we're seeing out of the White House in a way that has real-world implications. And I'm sure a lot of people in this room here are exposed to the multinational world in some form or another, and you're seeing it, I'm sure, every day in the kind of just the context for indecision that's being provided. I used to, it was a great line of mine for a few years, talk about how that Brexit would be the greatest act of national self-harm, economic self-harm we would see in our lifetime. I have now got a new line. Trump 47 will be the greatest act of national self-harm, economic self-harm we will see in our lifetime. And the challenge is it will harm more than the United States in a way Brexit didn't really. It has massive global implications. And I think And the great irony here, it's screwing the United States. So the relative decline of the United States is enhanced by Trump 47. And in a sense, that's just going to create a disruption that is negative overall for the world. The other thing I would say to you is, the other irony of all of this is it's not going to address the real issues that have driven these popular democratic expressions of Brexit and Trump, which are all around inequality, deindustrialization, because migration, what I would say trade, and also wokeism are not the causes of the issues that drove the voting for the individual and the referendum. And so, unfortunately, these issues remain and will continue to have populist expression in our democratic societies. Trump 47 is not Trump 45. Trump 45, back in what was 2016, he did not expect to win that election. He was as shocked, as surprised as anybody was that night in November. Consequently, he leaned on the GOP conventional system to get into power. He also didn't know how the system worked. And so he ended up massively constrained, surrounded by generally functional, competent administrative executives with conventional views, generally based on fact and analysis, about how to get things done. And also just, took 6-9 months to fill out the political appointees in the administration. It was just ill-prepared. This is not the case. Today, he is surrounded by a combination of incompetence, where telegenic quality is the primary criteria, or ideologues. And this is really important. Trump himself isn't really an ideologue. He has some really unconventional, really hard-held views, like on trade, like on reconstructed late 19th century perspective. But there is a right-wing Christian nationalism that surrounds him. It's there in Stephen Miller, Deputy Chief of Staff. It's Peter Navarro on trade. And a name you may or may not have heard of, but the Dark Lord himself, Russell Vought in OMB, which is effectively the check signing part of Office of Management and Budget of the federal government. He authored a report called Project 2025. ChatGPT it, if you want to know what the US administration is all about. But basically, this was produced 2 years ago, which was a right-wing nationalist, a Christian nationalist agenda for Trump 47. And the individuals who are very smart and very capable that were behind that are now surrounding Trump in the White House. And he doesn't have either the intellectual rigor or analytic competence to really understand what he's doing, but he loves the expression of power that's implicit in the policy. So what's this ideological expression? So there's a couple of dimensions to it. So the first is the destruction of the non-partisan administrative state. Now, I'm the first person, on another day I'll be giving out like hell about the public sector's efficiency and effectiveness and delivery, which politicians have been bearing the consequence of in democracies, but it's a huge issue. However, the answer is not what Trump and his administration are doing. So I'm using a vase analogy to describe this to people. So when you have a vase of flowers, and there's some flowers you like and some you don't, what you don't do is pick the vase up and toss it on the ground, and then go down and pick up the flowers you want, and then there's no vase to put them in. And that's what's going on. And what you're going to see over the course of the next 12, 18 months, 2 years, is the effective administration of the United States begin to fail. It's been driven by an ideology that says these non-partisans, this elite, bureaucratic elite, are preventing me deliver my political objectives. But fundamentally, it's going to end up, and it's been weaponized as well, but fundamentally, it's going to reduce the effectiveness of the US state. We clearly have the implementation of a Christian nationalist social agenda, which is in the papers every day. And then what you're also seeing is a material expansion of executive authority. When the United States was set up, it was about this tension between the executive, Congress, and the judiciary. There's an executive unitary theory, which again you'll see in the Heritage Foundation's Project 2025, which says actually there should be no constraints on the executive authority. And that's unfortunately been enabled by the Supreme Court, who last year in July, in Trump versus the US government, basically said that a president could not be held liable for any decisions he takes in power. In other words, he or she is unconstrained in the sort of expression of their executive authority. And even on the fringes of what might be assumed as their executive authority, there is the assumption they're acting within the law. This is a big deal because as he begins to assume this office 3 months ago, he basically begins to rewrite how presidents behave. And that's combined with an assault on the other institutions of state, Congress, judiciary, and effectively civic society, the universities, cultural institutions, and the media. And I say Congress because even though Congress is controlled by the GOP and in effect are his lapdogs at one level, because the GOP, again in contrast to 4 years, is in his image, and he's shaped it in his image, he's ignoring Congress. He's doing it all by executive order. It's a fundamental assault on the power and authority, which won't get tested unless the Democrats win Congress or the House of Representatives at least back in 18 months. And clearly, immigration is the other dimension to that ideology. In addition, then, we have a few what I would call Trump flavors on top of that, particularly around trade and particularly around security, which is shaped by the sense of the United States has been a victim of the last 80 years, which is measured in a very narrow way by trade deficit and surplus. It takes no account of the fact that the global economy is now transformed, the service industry denature of a huge part of the economy, and also the massive financial benefit the United States has gained from being the dollar being the reserve currency of the world, which John touched on and I'll come back to. I think there's a couple of other dynamics that you have to take into account. One is tax, tax, and tax. Everything politically in the GOP is around extending tax breaks introduced 10 years ago, which will expire at the end of this year. It's about $2.5 trillion plus. And back to, again, John's sort of picture on the deficit, that has to be dealt with in some way. And there's only two ways. You can borrow more or you can cut expenditure. And in a sense, that plays into trade as well. And the tariffs maybe help on the revenue side. But that pressure to deliver that tax extension is going to be enormous and dysfunctional in its consequences. And then finally, China, where there is bipartisan support for challenging its rise, both on an economic and security basis. And but again, back to the lack of consistency, a whole load of the initiatives undertaken by the Trump administration undermine any sort of geostrategic challenge to China. So what are the implications? Number one, this new world order that I mentioned, the breakdown in the rule-based order, of which it will be the EU, will be the sort of the bastion of hope that to kind of sustain it. Because not only will China welcome it, the Global South and a lot of the big economies in the Global South will welcome it too. Whether that's India, Brazil, South Africa, et al. Might is right is now the most succinct way of describing geopolitical dynamics and trade, as in the case of what the US is attempting. We're seeing that play out obviously with Russia and Ukraine. We're seeing it with Israel in the Middle East. We're seeing it Rwanda and Congo. You're seeing it an element in Sudan. I mean, and you will see it with China and Taiwan. So, like, as you think about the massive shift in what it means geopolitically and geostrategically, this might is right dynamic, which with a change in administration may come back a bit, but you can never, if you're Europe as an example, count on the US security guarantee again. And if you're in Southeast Asia, what faith have you in the security guarantee for Taiwan and implicitly for those around like Japan, South Korea, etc.? So second, and John touched on this, but I would share his view, the risk of serious US recession and consequently broadly negative economics for the world is very real. I touched on the Michigan survey. The biggest issue is the uncertainty. What do you do as a consumer or as a corporate or an investor if you can't rely on the environment? You put your hands in your product and by the way, your pocket, and by the way, the risk premium, as John said, goes up materially. And that emerging market analogy is not misplaced. You've got a clientelism dynamic now to the White House, which is classic emerging market. It changes the rules of the road fundamentally. And that has implications then for how is the response, but with the inflation dimension in the mix, that classic central bank riding over the hill on the white charger to save the day isn't necessarily going to be there, which would give huge concern to the length and extent of any kind of recessionary dynamic. And then, as John again eloquently pointed out when he had slides as well to show, the deficit picture is really poor, generally speaking. It's in complete contrast to what you might expect going into a recession, which again limits flexibility. Third, advantage China. This is all good news for China in its relative competition with the United States. It will clearly, obviously, have to deal with some pain, but far greater from its perspective is the massive weakening of US influence and soft power. It has really significant economic tools to counter the United States position, whether that's on agricultural demand, whether it's on rare earth processing, whether it's specific targeting of either the services sector or US corporates. And it will be fundamentally strategic in how it responds. They have no AI disadvantage. DeepSeek put that to bed. And I do see the competition in that space being intense, but certainly but that anticipated relative weakness isn't there. And then finally, they're just laughing at the security guarantee evaporation. Certainly, if I was in Taiwan now, your only hope is a kind of Ukraine strategy, but ideally before Ukraine, which is to create such sufficient concern in the Chinese Communist Party that actually an invasion would create some long interminable conflict that ultimately with little or no near-term resolution. So what about Ireland in that context? It's tough. First of all, we're a small open economy. We've absolutely made the right strategic choice in playing that role in the global economy and doing that within the context of the EU. And we've been enormously successful. And that's obvious in the world, by the way, right? Okay, I mean, wherever you go, for the tiny nature of our economy in Ireland and population, we've been extraordinarily visible. But we're caught on two sides with the tariffs, right? So coming from the US, pharma is at risk. Now, it's not immediate. I mean, these are 25 years decisions you make around building these facilities. So it's not like they get shut down tomorrow. But it's the next phase of decision-making where that flows that will inevitably some relative allocation back to the United States. But the response from EU may get at tech, which is exposed from the US side too. But in a sense, that's one of the ways for Europe to gain real leverage over the US administration. And so we're kind of caught in the middle of that. And walking the political line around that is going to be very challenging for us. I think that, clearly a US recession will have negative economic implications here. John already touched on, let's call it the perception issue and the greater fragility in our in our budget position than the headline. And I think that on top of the classic challenge in terms of needing to fund a whole range of social services and other demands, we're going to have new demands like defence, where we have been, in a way that geopolitically, we have no choice, but we have to spend 4, 5, 6x what we've been spending on defence. We have been negligent at the wheel in that, and in a sense, I was talking to a great friend of mine, Adrian Jones. He's chairman of Goldman Sachs private equity business, former Irish Army officer from Tulse County, Roscommon. And we were talking about it 2 weeks ago, and he was talking to some of his friends who are now at the top of the army, and he says about this new context for investment. But he says they're so conditioned by the last 30 years, they're struggling to get their head out of what's now required for Ireland in a defence context. But in a sense, we'll have new challenges on the spending side. I also would say to you, the pressure to deal with public sector inefficiency and ineffectiveness and lack of delivery is going to build. It's been a huge driver, when you look at it, of a huge amount of populism around the place. But it's going to have to be addressed. Either gets addressed by the conventional political system, or will it get addressed in other ways, as we're seeing Trump undertake in the United States. But certainly, there's a better way to go about than what Trump is doing, but that rises up the agenda from my perspective in a huge way. In terms of you as a business owner or service provider, whatever your particular interest is, it's time for caution. It's a volatile world with massive uncertainties and big downside risk, and so you're going to have to be very thoughtful about how and when you're deploying. You've got to scenario test your resilience to economic slowdown, to the impact of the tariffs, to the cost of your leverage in the context of any business challenge. You've got to look at your supply chain. You've got to see what the implications are directly or indirectly. Think second or third order. Paul O'Donovan and Associates, I can recommend as an advisor for anyone who needs advice in this current uncertain environment. And then on sustainability, because John insisted I talk about his sustainability, don't give up on sustainability. And I'm going to get on a little hobby horse just for a second here. So the sustainability ESG movement effectively morphed from something which was shaped around thinking about risk. So ESG criteria is just a list of risk criteria. And the risk criteria, which 10, 15, 20 years ago, whether we're saying on climate as an example, but also social impact of your activities, didn't really have a cost in the short term. There was medium, long-term costs there if you weren't careful. But those costs are now much more direct and apparent, okay? And your ability, your social license to operate, the environmental impact of what you're doing, these poor governance, these all are risks with costs. And what they were great for was identifying these costs that might be in the future, which we are typically poor at, where we tend to look at what we see and can cost today. It morphed into a more value-based judgment about what was right and wrong, and it also morphed into this regulatory kind of momentum, which became massively burdensome and more about compliance than actually change. So for your business, take no comfort from the fact that the Trump administration is looking to roll back dynamics on climate and other social and other regulatory obligations, environmental, whatever. The change is there, the risks are real, and they remain for your business. And they remain for your customers, who may well continue to look for you to hit higher standards across a range of dimensions. And so, so get away from thinking about this as a value-based judgment as to what's right or wrong. Get back to thinking about this around a range of risks that are relevant to your business, which may not have the price or cost today, but will definitely have tomorrow. And as an infrastructure investor, you live with that, because if you build a piece of infrastructure which has ultimately got real social negative impacts, I'll pick something random like the West Link, okay? Ultimately, there will come a price rise that triggers a political backlash, ultimately forces the buyout of the asset. Now, fortunately, the contract was fair, and we negotiated a reasonable transaction price. But the point being, this stuff does have cost. And so if you blow up a whole set of Aboriginal caves in Western Australia, and you're the CEO of and the senior executives of one of the major global mining companies, you will lose your job. So there's real cost and consequence now in the way there hasn't been in the past. That's much more immediate. On climate, it'll come as a huge surprise to you, but it's real, okay? It's real. July 22nd, 2024 was the hottest day on record. 2024 was the hottest year on record. 11 of the hottest 11 years on record were the last 11 years. The concentration of greenhouse gas heat-containing gases in our atmosphere is the highest level ever in the history of humanity, and beyond, well beyond. This is real. 1.6 degrees temperature last year. That's not a long-run average, which may still be below 1.5 degrees, but forget about hitting 1.5 degrees. Transition has begun. Trump will make it more expensive and make the change more traumatic by virtue of what he will implement with his administration over the next few years. But fundamentally, it's happening. My guess says, talking to climate scientists, we're probably heading towards 2.5 to 3 degrees centigrade on the back of existing policies and pace of transition. Challenge you have is the impact of climate on our way of living is not linear. It's exponential. So every 0.1 degree increase is actually massively material in what it means. And the other big thing is it's so complex we just don't know. So as you think about that front, if you're down in Youghal or in West Cork and you got a lovely house on the beach and you think, south of France, here I come. If we lose the North Atlantic Oscillation, which is a real risk with the melting of the Arctic and particularly the ice on Greenland, then we'll be Newfoundland. So, though I did see one paper that says, on balance, we'll be back where we were because the world will heat up. But the bottom line is we do have, whether it's monsoons, whether it is the massive ocean flows, we have massive uncertainties. And one of the big things is that the short-term impact has been greater than what's predicted, and it's largely down to heat in the water. And so there's real concern in the scientific community about just dealing with much greater impact earlier in that temperature rising than was anticipated even a few years ago. So I used to think, maybe if like 5% of Los Angeles burns down, maybe people might get serious about it. But no, we seem to be immune to these climate events that are increasing in ferocity and impact. 3 months of rain falling in 3 hours is implication in Western Spain or Eastern Spain as an example. We're kind of immune to them, but what we won't be immune to is the financial impact. And John touched on it, and I think insurance is the canary in the coal mine. I'm going to give you the California example. So in California, by virtue of the wildfire risk, there's been increasing, and there's a cap on insurance rates. And so what's happened is that there's been capacity withdrawn from the market. So they implemented a number of years back the thing called the FAIR regime, which is a state-owned scheme. If you can't get insurance from somebody else, you can get it from FAIR. FAIR are more market price, so you see big increases in your premium. Anyway, after Los Angeles, they burned through the few billion of capital they had on their balance sheet, FAIR did. They then ran through about 4 or 5 billion of reinsurance. And on top of that, because they can't go bankrupt, they put a levy out on the general insurance industry in California. So the approved levy, I think today it's been about just over $1 billion, but there's still an expectation of maybe 3, 4, 5 billion to come in terms of a levy on the general insurance industry. So if you're an insurer and you didn't do basically property insurance, commercial or residential in California, you're still caught on the back end with that levy. So that has massive implications. And by the way, all the carriers in reinsurance have all blown through, most of them blown through their cat risk budget for the year in January. It's normally seen as a Q3 risk from a budget perspective. So these balance sheets are not limitless. Main board director of Allianz within the last week basically came out and said it was a risk to the global capital system. Because as John pointed out, you pull away insurance, you pull away the value of your asset, you pull away ability to raise debt, to trade in assets, buy or sell. So this is the canary in the coal mine. This is real cost. And the governments, back to John's main point, don't have the balance sheets to step in and just keep writing checks to mitigate the impact. And so transition is coming, and as you think about your business, you got to think about your carbon footprint. The good news is renewables are cheap as chips. We just got to get out of our own way with respect to policy and grid and a whole bunch of stuff, because the answer is very simple. It's get ever more out of every unit we put into the economy and society of energy. So efficiency, generally the IR on that is fantastic. 2 is electrify everything we can, because we can decarbonize electricity really cheaply. In India, 2 weeks ago, 2.5 cents a kilowatt hour utility scale solar, with their cost of capital, which is higher than here. And finally, you're going to be left with a bunch of difficult stuff like maritime and aviation, certain industrial process, cement, steel, and there will be new technologies in the mix there. But fundamentally, we have no choice. This has to happen, and it has to happen now. With that, I am going to join Paul on these lovely, comfortable seats. I think he has a couple of questions, and then we might open it up.
Thanks, Jim. Very detailed presentation. A lot to think and go through there. If we start with the States, maybe, you're mentioning Mr. Trump. Is there any constraints to what he can or will do?
The great news is the markets are immune to bullying, immune to DEI policy and other social assaults. The markets are the discipline on him, right? What's had him change policy on tariffs in the space of a few days? It's the market reaction. But the one to focus on, and my partner is a bond trader, so I've got a whole new love of bonds, like John. I came late to it, John, but I got there. The bonds will tell you everything. And that's what scared the living hell out of everybody. Because what should have happened was that bond rates should have gone down on the expectation of the economic decline and ultimately interest rate policy being adjusted to recover. Instead, they increased. A lot in the mix there. There was a lot of hedge fund trades that needed to unwind. They had to sell what was available, and that treasuries tend to be more liquid and ability to sell. But fundamentally, there's a real challenge to the dollar as the global reserve currency. David Merriman was there saying a whole lot of institutions just been onto them, unsolicited, looking to take money out of the US, put it into European asset managers. There's a real big concern about its role and what replaces it. And central banks are gaming this. And the big risk is that if you take a view that the dollar's role is finished as the global reserve currency, then you want to be the first out the door, not the last. And so the real crisis implication here is that a fundamental shift in sentiment sends people for the door, which has very dramatic short-term financial implications. And the implications go way beyond the United States because everything is priced off US treasuries in the global financial system. So again, I am great crack, by the way. I mean, no, genuinely. No. Like, get me going. Listen, 2 boys through Blackrock College in Dublin. And you know what? They're both Munster rugby supporters, okay? Now, they've no friends, but fuck it, it was worth it, okay? So I'm great crack, really, okay? But that's the big constraint, is the markets, and there's insider trading, all sorts of other stuff you can be sure going on, but the bottom line is the markets are objective, and they will continue to express their view on the administration. Now, it won't stop him doing what he's doing more generally speaking, around migration, around the assault on civic society, challenge judiciary. But it's really important as well that the judiciary stands up, and the Supreme Court in particular. There's a big decision before them it's before them as an emergency case. The expectation is that they'll take it as a proper case because it's too important. It's around his executive authority to fire people, and it's all about whether he can fire Jay Powell. That's not before the court, but if he gets the ability to fire the couple of, one's the Labour Board, and I can't remember what the other is, but fire those executives, which are kind of independent agencies, then the fear is he goes after the Fed. And Jay Powell, interesting enough, is up as chair next year. He's not up as a Fed governor for another 2 years. So he could choose to stay down as, so the expectation is he stands down as chair but doesn't come off the Federal Reserve Board. But and by the way, back to the first point, if Trump goes after the Fed, then like really buckle up, because that goes right to the heart of the dollar's kind of role, let me put it that way, and the objectivity around the central bank or the Federal Reserve. But that decision, it's Trump versus somebody or other, but that's up for decision this quarter, and could be massive. If they give him free rein, then I think you may see a dramatic market reaction just in the back of that. Also, civic society needs to stand up, and lawyers have been rolling over. Typical bloody lawyers. I mean, the accountants are much better, but Harvard stood up last night, first of the big universities. Now this morning, Trump was saying, $2 billion taken away from you, but like civic society needs to stand up as well and challenge the authority. But it's going to be ugly, is the short answer.
You said advantage China. Do you believe that, given that they have more exports at stake in a trade confrontation?
Look, again, the world has changed dramatically. It's not a physical, good traded world anymore, not just a commodity traded world anymore. China, I think 2% of the GDP is exposed to the United States. There'll be pain, you can be assured. But I would say as much pain will be felt in the United States, because the stuff they're importing is not stuff that they don't need. It's air conditioners, it's computers, it's iPhones, it's like you name it. And that's why he backed down over the weekend on some of the tech. But they're in a position, I mean, they are so strategic. It's an authoritarian regime, massively controlled. They can withstand way more pain than Trump can withstand, whether it's driven by the markets or populist or popular sentiment. And they're just going to play the long game. I touched already on the factors that are there. Mao, when he took on the United States and Korea back in the 50s, described them as a paper tiger. It was, in other words, we will win because we'll just be able to stay longer and be able to bear the cost to a much greater extent and greater tenor than the United States. And he was right. And that's the exact same today. And Trump has no clue of that. There's no strategic sense of that. They are looking way beyond Trump because he's only got another 3 years. Xi could be there for another 15, 20 years. And they're focused on Taiwan. This, as I touched on already, this is great news for that. Everyone in Southeast Asia now is like, they're not making their way to, they're making their way to DC just because they have to. They're making their way to Beijing. Xi was in, or Xi's in Vietnam today, or he's coming to them. Bottom line, China's ability to express its influence in its backyard has just gone up by multiples. So yeah, it's advantage China.
Just throw a few questions out to the floor. Has anyone any question for Jim?
Thanks, Jim. When you look at the game of chess as it evolves with Trump, like with Gaza and Ukraine, how do you think that will evolve?
So trying to predict what Trump will or won't do, because is like at one level is a bit of a mug's game. I think Ukraine has to be seen off where Europe has to step up and save Ukraine now. Okay, I think that's you got to hope that the U.S. continues to maintain some element of military support, particularly intelligence. But other than that, Europe has to see this as its problem, and it's got to put the resources, as a whole bunch were announced this week, has to put the resources behind Ukraine. But it's but there's just no consistency, okay? And he responds to authoritarians outside of Xi and China. He really embraced them. We had Mr. El Salvador in yesterday, right? I mean, the bottom line is like he just loves that model of governance, which is how we operate in business life, and he instinctively respects it in a way he doesn't respect, fundamental liberal democracy. So from a Ukraine perspective, Europe has to stand up. Was the other Middle East, was it? Oh, yeah. Pick an easy one then, wouldn't you? Look, Israel is dominant, okay? I think there's a number of things there we're going to look back. First of all, I think that's the first real AI war. Within 2 weeks of October 7th, the Israelis had run out of targets, and you can be assured various tech companies and others, I won't mention names in case I get sued, but basically have been providing to create targets and using mobile phone signals, face imagery, a whole bunch of stuff, behaviors. And then they moderated the collateral damage. It used to be 20 civilians for one senior leader of Hamas. It changed to 20 for anyone they thought might be Hamas, to 200 for a senior leader. But that's been a continuum since Grozny in Chechnya, Syria, Ukraine. Like, look, war has got ugly. Forget about Geneva Conventions. Back to rules-based order. There's no rules-based order. Might is right. So Israel has a phenomenal military system, and they've defeated Hezbollah. They've in practice defeated Hamas. Syria has moved into a new role, but they've now moved into Syria, taking land. The question is, what pressure is there to deal with the fact you've got two people sharing the same plot of land? And I think my gut tells me it's a long, drawn-out, no-end situation. There's no pressure to bring around some functional solution for Palestinians in the general Palestinian area. Trump's idea is just complete nonsense, but ultimately there is zero pressure on Israel to come to any settlement. But for Israel, strategically, it's massively negative in my view, because their influence in the world is much diminished. The Israeli government is a product of the right wing. That's what's holding it there, and so that's why it's so extreme in its policies. Is there a chance in an election, which could be well over a year out yet, that a more moderate Israeli government looks for something more functional? Maybe, but that's about the only thing I think that can bring it about.
Could I ask, will that country club Republican class get control anytime, do you think? No. Dan Mulhall kind of said there's a possibility, but you think not?
No, they lost. They lost over the last 3 years as Trump took control, notwithstanding a whole series of electoral outcomes and stuff that seemed to fly in the face of Trump and his influence. He took control of the Republican machine, and doesn't control it fully. So you have, for example, and what you see in Congress is you'll see some of the classic fiscal conservative Republicans are still there, and that'll feature in the whole tax budget deficit dynamic as it plays out later this quarter. So he doesn't have the full control, but going back to what it was, no time soon. I would expect that, again, we're into realms of massive speculation here, but there is, even with if there's a Republican loss next November with Senate and House of Representatives, which is not guaranteed, by the way. I think so, but the Democrats are in disarray. But assuming that goes through, and Trump doesn't engineer some, extension, then he will have someone like J.D. Vance up, representing his thinking. And the challenge is, in the primary system, it's the extreme of your party wins, right? Okay, they'll turn out because you only need, kind of 15, 20% of the electorate to rabidly believe you're the person and your policies are right. So the question is there sufficient economic fallout for the United States that ultimately gets at this rabid support for him? But that's the only, and that's going to play out in a number of years, and it'll be messy. So, but there's no quick fix there.
And then if you were to follow that through, the Financial Times today says Europe really has to choose and will visibly have to choose between the US and China. And so the prognosis that you'd almost be saying is that we should be tilting a little bit more towards China and try to play the middle road. But the reason the Financial Times says that is because they're saying the US will take exception to that, and it will almost push Europe in that direction.
Yeah, so I think Europe would be better off. So Europe hates this position, right? This is the last thing. Though, interestingly enough, MAGA may be mega, right? Okay, it could make Europe great again in a sense that these are issues like on defense and security. Europe should have been dealing in its own right. And we do have this massive free market. And we do have an ability to engage with other economic groupings to continue to push globalization. But it's being compelled now to take a much more constructive approach to China than it might otherwise do. I don't think, it's a bit like Ireland between the EU and the United States, I wouldn't pick sides. I'd be kind of trying to fudge it, okay? In the same way, I think Europe needs to stand up to the United States, but do that in a very smart way, because ultimately, the challenge is Trump will just think he just doesn't like Europe and will think he ultimately is stronger and can bully. So you'll really need to be smart to target weak spots in his ecosystem to kind of stand up. But I think in the mix there, you don't overtly go towards China, but you definitely constructively engage with China. And I don't think that in any way will make it worse for Europe versus the United States, because I think it's just bad. It's a bit like the tariff comment that Brendan made, you know what I mean? Above 50%, who cares? It's a bit like, he hates us anyway. Is he going to hate us that much more? Does it really make a difference, right? And but Europe is going to engage more constructively with China than it would have in other circumstances, no question.
Jim, sorry, just on that then, no mention of Russia in this so far, and obviously we're in a pincer movement in Europe between Russia, China on the one side and the US on the other side. Will Russia have a feature in this at all in the next couple of years?
So of course it does, because there's kinetic activity on the eastern borders of Europe, okay, which is massively negative in its implications. But the Ukrainians are fighting our fight, okay? I don't buy that Russia will be heading into Estonia immediately afterwards. It's a completely different exercise for the Russian army to take on, the European military, even without US support, okay? There's just a different level of training, different level of sophistication, different level of weaponry at its disposal. Do I see Russia continue trying to use, kind of other elements of warfare, intelligence, system, IT, AI-based? Absolutely. So Russia's a threat, but Russia is a declining entity. It's commodity-based, it's a plutocracy, and so as you think about the strategic game, it has some relevance, but it's not a dictator of events. However, Europe has to stand up, has to support Ukraine economically, has to support it militarily, in a way that kind of at least maintains the status quo. Because I think that's the best you can hope for in a world where the United States is so pro-Russia.
A quick question. You spoke about all the negativity associated with Trump. Can you see any positives with Trump in power?
So no would be the short answer, right? However, but let me make some observations about Trump. So first of all, he is unbelievably politically intelligent in terms of understanding what people want to hear and communicating in simple, typically incorrect terms, but in a way that makes them happy and that he has their back. And in a sense, he couldn't have done this 15 years ago, or 20 years ago. It's a moment, and it's tied into social media and a whole bunch of other dimensions as well. But fundamentally, you have to respect that. Now, the fact he'll do nothing for that constituency, and probably even worse than nothing, it would be extraordinarily damaging, is an irrelevance. And they won't give up that easily, right? Okay, I mean, you still can't have a really rational conversation in the UK about Brexit, okay? And the last thing that will work is the Democrats saying, "We told you so." But I think you've got to give him that. The other thing I would say to him is he is picking up on things that were wrong. Europe and security was wrong. You know, public sector effective. Like he's picking on things, going about it the wrong way. The volume control is way off the meter. But fundamentally, he's picked on things and called out things that needed to be called out at some level, and so you got to respect that too. But fundamentally, there's an administration in place that's taking down the global world order, and there's nothing good about that. Nothing.
Finally, Jim, for the Irish SME in the room, what's your advice in the medium term?
No, I think, look, I said it from the podium, I would be very cautious now. This is a time to really think about your resilience as a business, understand your economic vulnerabilities, scenario test, you know, a downturn in business, understand what your supply chain implications, those you have in particular manufacturing businesses, what that means. But ultimately, you know, this is not the time for growth and expansion. This is a time for pulling the horns in and just thinking far more conservatively about, you know, kind of how you deploy your cash. Don't lose sight of climate and sustainability. It's a real thing, hasn't gone away. But think about it with that risk framework rather than any sort of value-based judgment about what's right or wrong. And look, I mean, this up. AI was touched on. I mean, there's so many things we could talk about. But like, you know, though I was at something yesterday in London. Apparently, AI can have catastrophic forgetting. And now I have that with Paul. I have the morning after night out with Paul. But apparently AI can have catastrophic forgetting. So it's not good with changing dynamics. It can learn to do something, but if it then goes on to do something else, it forgets. So in the same way there was a lot of greenwashing in the day, and may still be, there's a lot of AI washing going on as well. A lot of conventional algorithm stuff, etc., all getting AI washed. But it is very real. We were talking earlier, those young data scientists coming out are out of a job because AI does it in like seconds. The challenge is we need them to get some experience, so there's challenges in the mix with AI, but it is material, massively material, particularly where there's massive amounts of data needs to be simulated in a whole load of different ways, which will affect everything at the end of the day. But anyway, but look, I mean, generally speaking, it's just a different world, but we'll adapt, we'll succeed and fail in a new context, but you have to understand the world has changed.
Ladies and gentlemen, can show your appreciation for Jim Barry. Thank you.
I never mentioned nuclear proliferation. Sorry.
No. Thanks, Jim. That was very interesting. And you do sort of seem like good crack as well. So that's good. So up next are our taxation experts, Mairead Hennessy and Julie Healy. They will address succession, mergers and acquisitions, retirement and tax-effective business exits, as well as looking at what's coming down the tracks. So Mairead Hennessy is Managing Director at TaxKey, and she founded the firm in 2016 to deliver top-notch tax advice, with a specific interest in succession planning and tax-efficient exit strategies for business owners. Julie Healy is Tax Director at KPMG, specialising in private enterprise and family businesses, including group restructures, mergers and due diligence, with a very particular interest in succession planning. So, thank you.
Thanks very much for that introduction, Siobhan. Good morning, everyone. I think we're still in the morning, just past noon. Delighted to be here with you this morning. It's been such an engaging and interesting event so far. So hopefully when you hear tax, you don't think, oh Lord, okay, this is where it all takes a turn. So I suppose I'm going to talk to you just around succession planning for businesses, business sales. And when we talk about succession planning, sorry, where's the, oh yeah, sorry. Oh. Sorry, how do I, sorry. Oh, sorry. Oh, yeah. This one here? Yeah. Okay, good to go. Okay, so I'm going to talk to you today about the different steps and considerations in succession planning. First of all, setting the context, and then within that, some of the main tax considerations to bear in mind. So firstly, we'll talk about the benefits of succession planning. Why do it? You know, it's a real case of, you know, don't let the urgent overtake the important. Succession planning is extremely important, and we'll look at some considerations around that, particularly on the commercial side of the business. We'll then move into looking at tax considerations, the main tax reliefs at a relatively high level, the things to think about in terms of making sure conditions are met, and that's where the planning ahead really comes into its own, to make sure that, you know, that you are there with the conditions met at the right time. Structuring the exit, there's different ways to do it, whether it's passing a business on to the next generation, it's a third-party sale, an MBO, a share buyback with an exiting shareholder and some of the other shareholders remaining in place. There's different ways to exit, and we'll look at some of those options. And then in the context of family business transfers, where you're looking at transferring a business down to the next generation, maybe on a phased basis, holding off transferring that control, but still getting the business transferred across. What are the options there? We'll take a quick look at those. And then finally, to finish off, we'll just take some simple case studies. So the benefits of succession planning, look, it all comes down to stability for the business as it goes through a transition. You know, we've heard so much about the volatility in the geopolitical landscape, and there's so much going on that we can't control. So it's about controlling what we can and trying to steady our own ship through the transition. And that preserves value. A business that has a succession plan within its own leadership, that has that plan, is perceived to have higher value simply because it's mitigating that transition risk as the existing leadership moves on to make way for the next generation. And that, of course, protects the long-term growth. So by doing your succession planning, you're protecting your business and you're protecting the other stakeholders, the employees, all of that, your clients. It keeps the ship steady. It also enables tax efficiency, because by planning ahead, you can plan the tax release. You can plan, you know, who the shareholders are, what their roles are, will they have the shares for the requisite length of time, and it allows you as a business owner to be in place to claim those very vital tax reliefs at the right time. So what we're looking for is a smooth transition. So to build the business up, have it there, and then we move, whether it's to a third-party sale, next generation, or MBO. It's all about that smooth transition. And also to maximise flexibility. When we talk about, you know, in the case of selling a business, you can, where it's a company, you can have a share sale, or you can sell parts of the business by way of asset sale. And later on, we'll look at the differences and why in some cases it can be a share sale to a third party, and in other cases maybe an asset sale. We're also looking at protecting that family wealth and making sure that by enhancing the tax efficiency of a transfer, that wealth is retained and there's no leakage there by paying tax that could be avoided by better planning. So when we look at the tax reliefs, I'm just going to scroll on to this slide here. Okay, so when we look at both sides of the equation in terms of a business sale or succession planning, we look at the existing leaders, and the main tax for them is on capital gains tax. When you transfer your shares, whether it's by sale or a gift, capital gains tax comes into play. On the other side, say in a succession planning scenario where you have the next generation maybe getting a gift of a business, you're into capital acquisitions tax. And that arises whether it's a lifetime gift, so you get it during the lifetime of the existing owners, or you're left the business by way of inheritance. This capital acquisition tax comes into play. Where it's a lifetime transfer, there can also be stamp duty and there can also be VAT considerations depending on how the transfer is structured. But for now, we're just going to look at capital gains tax and capital acquisitions tax and the reliefs there. So on the CGT side, you've probably heard, about retirement relief, about entrepreneur relief. Entrepreneur relief has been with us for about the last 9 years. It's a very valuable relief. Retirement relief has been with us a good long time, I think, since back into the late 90s, and it's a very, very well established, valuable relief. But there's a lot of conditions with it, so that's where the planning really comes into play. And then on the CAT side, we have business relief. Again, there's conditions there, need to marry them up and make sure the beneficiary is in the right place at the right time to take advantage of it. And I suppose we'll see when we go through the conditions for the reliefs how important it is that both sides, say in a succession planning scenario, how important it is that both sides are engaged in the process. Like, we would see cases where maybe parents want to transfer a business to a child and the child is involved in the business, maybe has certain responsibilities, but the child isn't initially involved in the conversations. And that's, we're very much about promoting that conversation between the existing business owner and the beneficiary, because well, A, for the benefit of the business, how that business is going to continue on and flourish after the transition, but also from a tax perspective, certainly when reliefs are claimed, retirement relief, business relief, that the child needs to hold on to that company, to that business, and it needs to stay qualifying for an amount of time after the transfer. So really to have that beneficiary involved in the conversation so that they do understand what they're taking on and what the potential tax cost is if things change or they change their mind after 1, 2 or 3 years, and they go in with their eyes wide open. I suppose that's the key thing really. So we take first retirement relief. So retirement relief is available for individual owners who own the shares, own the business, the company shares in their own personal capacity. You're going to talk about retirement relief. So the individual, it applies where you're over 55. For disposals too, so when we talk about disposals, that's either a gift to a child or even where the child might pay some consideration for the company, which can happen too. So for individuals who are aged between 55 and 69, the current limit is 10 million. So that's businesses with the value of 10 million. For individuals over 70, it's reduced down to 3 million. So you can see there, the legislation is trying to promote that earlier transfer of businesses to the next generation. And the Finance Act brought us a gift this year that it introduced a 12-year clawback period for retirement relief. So this is a classic example of where, if the shares cease to be qualifying shares over the period of 12 years after the transfer, then a part of the CGT that was deferred by way of retirement relief becomes assessable. So 12 years is a long time, and that it comes down to what the beneficiary does over that length of time. So that's where they really do need to be educated on that. So, the following, during this 12-year time, the following conditions need to be met. The assets need to be maintained for the full 12 years. So if they're sold or they cease to be used for a qualifying reason, then they and actively used in the trade, then there will be a clawback of the relief that was given at the time of the transfer. That 12-year, I suppose importantly, that 12-year clawback, it applies to transfers of 10 million euro or over. So it's not for transfers below that, but still where we have those valuable, substantial businesses going across down to the next generation, very, very important. And that's that is a new thing that came in, just took effect on the 1st of January there this year in the Finance Act. So we have disposals to non-family members. In reality, we'd find that retirement relief doesn't typically come up as much in non-family transfers, and that's down to the thresholds. So where you're going to transfer a business to a non-family member, to a third party, there's a lifetime limit of €750,000 if you're aged between 55 and 69. Now, maybe where you have two spouses owning the business on a 50-50 basis and both have been working directors for the 10 years and the conditions are met, that 750 can be doubled up to 1.5 million. But a lot of the time you would find that where, obviously if you've got a business that's worth more than the threshold, you're out of retirement relief. There is a marginal relief, but it's, it tends not to, it may not work out as well. Then again, if you're aged over 70, that threshold is reduced down to 500,000. Again, if there were two spouses in the business and both are, and this again is planning, where both own 50% of the business and they're both running the business, have the shares for the 10 years, working full-time working directors, you can double that threshold. And that's a very important planning thing in a lot of businesses to double that threshold. So to get retirement relief, there are detailed conditions, and I suppose the main ones, just for our purposes here today, is that the individual shareholder who's looking to claim their relief needs to have owned the assets for at least 10 years in the business prior to the date of disposal. And
Sorry, does that include transfers between spouses? That has to be 10 years prior to sale, is it?
no, well, a transfer between spouses there's not going to be capital gains tax.
I know that, but the impact of the planning. So let's say I'm going to sell my company in 3 years' time,
Yeah.
and I own 100% of the shares. If I transfer half of that to my wife today, does she have to have owned it for 10 years, or will it look back to when I own them?
It'll look back to when you own them as well. Yeah, for retirement relief, not for entrepreneur relief that we're going to come on to in a minute, but for retirement relief it does. Yeah. And the same if you have a sole trade and you decide I'm going to incorporate, depending on how that incorporation is done, the 10 years can include the pre-incorporation time, but only if it's done in a certain way. So again, if you're looking at a sole trade and you want to incorporate, for whatever reason, and just to make sure that if you're looking at claiming retirement relief subsequently within the next 5-6 years, that it is done in such a way that you can include your the years that it was a sole trade in that 10-year test. So this is where the planning really comes into its own. So where you have shares in a family company, because retirement relief can apply to business assets in a sole trade and to shares in a family company. So you must have owned your shares for at least 10 years. You need to have been a working director and at least full-time for 5 years in the 10 years up to disposal. And that working director factor is really, really important. You need to be able to demonstrate, what your role was, who you were managing, what you were doing, your service to the company, and over the requisite amount of time. That's a really, really, really important thing to bear in mind when you're looking to claim the relief. The company must be a trading company. It can be a farming company. Farming companies can qualify. And you must own at least 25% of the voting rights. So when we look at the shareholdings in the company, and the type of shares. So to get the relief, you need to own 25% of the voting rights in the company, or at least 10% of the voting rights. But the claimant, together with their family, need to hold at least 75% of the voting rights. So the other relief that comes into play, because retirement relief is a full exemption. Where it applies, it's a full exemption. So that's always the first relief that you would look to. So the next one then is entrepreneur relief. So I suppose where we don't have any relief, I suppose just say from the outset, where we don't have any relief, CGT applies at 33% of the gain made. So that's the difference between the proceeds that you get either in a sale or the value of your company at the time of transfer, at 33%. If you can claim retirement relief, it's exempt. If you can claim entrepreneur relief, it's 10%, up to the first €1 million of gains. So still a very, very valuable relief. To get the relief, again, there's conditions. You need to dispose of qualifying business assets. You need to have owned the assets. Now, the ownership period is less onerous for entrepreneur relief compared to retirement relief. It's 3 years in the previous 5 years. It's not 10 years. The assets that are being sold need to be qualifying assets, and broadly they're business assets, trade assets. Investment assets don't qualify. I suppose to give you a long story on that one. Where the disposal, the assets we're looking at with the disposal of shares in a family company, you need to own at least 5% of the ordinary share capital. So the ownership requirement isn't huge in terms of the amount of shares, the amount of equity that you need to own in the company, but it does need to be of the ordinary share capital. You need to have been a director or employee of the company in the 3 years, for the 3 years in the previous 5 years prior to the transfer. And you need to show that you've spent at least 50% of your time working in a managerial or technical capacity. And that's a condition. A revenue will hone in on them all if they're looking at a claim for the relief. But one that I do see them looking at, that does always come up, is that technical, managerial or technical capacity. What was the role in the business that the claimant, the person who's claiming the tax relief, that they were playing? Did they have, were they making decisions on behalf of the company? Did they have people reporting into them? Were they overseeing the client relationships? Were they in charge of, authorising payments out of the bank account? What was their managerial or technical role in that business? And, when you're claiming, if that relief is going to be claimed, I would always recommend that how these conditions are being met is documented at the time, so that if there's ever anything afterwards, that, you have it there exactly how these conditions were met. So that's really, really important. So the relief applies to chargeable gains up to a lifetime limit of €1 million. So when we talk about the €1 million threshold, that's a lifetime limit. Again, in the case of, say, two spouses working in the business, say one spouse owning 50%, other spouse owning 50%, both working in the business and meeting these conditions, working in it as an employee, director, managerial or technical capacity, that €1 million threshold doubles up to the 2 million. But each spouse needs to meet the conditions in their own right. And once you're over that €1 million of threshold, the excess over that is taxed at 33%. Oh yeah, sorry. Okay, so that's on the disponer side, the current business owner side. So when we go to the next generation, we've got family coming in and we're passing the business down to them. The tax relief that they're going to be concerned about is capital acquisitions tax business relief. And as I've mentioned, that capital acquisitions tax, or CAT, comes up either by way of gift or inheritance of a business. And again, we have conditions, so this is where the planning comes in. It's a very, very valuable relief, because where it applies, the value that's taxed, the value of the company that's taxed, or the business that's taxed, is reduced by 90%. So it's a huge, very, very valuable relief. It applies to relevant business property, and that's an interest or a business or an interest in a business. It could be shares in a company that's carrying on a business, and other trading assets held outside of the business, like land and buildings, once they're used for the purposes of the business. To qualify for the relief, the business needs to be carried on with a view to making profit. And on the face of it, that seems like a very straightforward condition to meet. But if you're in a case where, for some reason, there's been losses generated repeatedly over the last number of years, that condition comes into play. So just that you're able to demonstrate how the business has been carried on with a view to making a profit. The business property needs to be owned by the party that are making the transfer for a minimum amount of time. That's 2 years in the case of an inheritance, or 5 years in the case of making a lifetime gift. So it's not an overly onerous length of time, but it is there and should be borne in mind. Importantly, again, the recipient, the beneficiary, needs to retain the ownership for 6 years. So that's where that communication piece, education piece really comes in, that the beneficiary understands. And I have a case at the moment, actually, where an individual inherited a very, very valuable business, Very, very valuable. And that 6-year time frame she wasn't made aware of it at the time before. It would have been her father she inherited it from. And that 6-year time frame has actually really become an issue for her. And I think had she been aware of that before her father had passed away, that I think things might be a little bit different. That 6 years is a very, very important time frame that the child needs to continue to run the business needs to qualify for the relief for that 6-year period. So if the property is sold, transferred, or doesn't qualify within that 6 years, there's a clawback of part of an amount of the tax. Okay, so that's the succession planning. So when we look at exiting a business, there's a number of ways we can go about it, and I suppose it depends on the circumstances and the individuals involved. And what we're seeing quite a lot of at the moment are share buybacks, and I'll talk in a moment about what exactly they are. I mentioned earlier on about the difference between selling assets and selling company shares, and the different scenarios where one would apply over the other. And also then the use of holding companies. I'm only going to touch on holding companies. You could spend a session on its own talking about holding companies, but just how tax reliefs do apply where shares are held by another company, by a holding company, rather than by the individual owners in their own personal capacity. Okay. So with a share buyback, at a simple level, there's shareholders in the business, and one, for example, wants to exit, whether it's retirement or the shareholders have fallen out, and they can't resolve their issues, and one shareholder wants out. So a frequent way that you would go about doing that is doing a share buyback. And the first thing you would always ask is, okay, are there distributable reserves? That's the first thing, because to do a share buyback, the company needs to be valued. And then the shares of the exiting shareholder also need to be valued. So with the share buyback, the company needs to pay the exiting shareholder, the value of their shares as those shares have been valued independently. So the company has to have the distributable reserves in order to do that. So once you've ticked that box, the next thing you're looking at is, okay, well, how is this share buyback taxed? And you want it to be under the capital gains tax rules, because then if you meet the conditions, you can possibly the exiting shareholder can get retirement relief, entrepreneur relief, you're in that space. But if you're not in that CGT space, that share buyback is going to be treated as what they call a distribution. So the exiting shareholder will be caught to their higher rate income tax, which is not a scenario that typically you want to be in. So to get the CGT treatment, the buyback needs to be for the company's trade, okay? And that is something that needs to take a lot of consideration. When the revenue are looking at these, and they do, how that company benefited from this share buyback. So is it a case that, it was part of a succession planning, a shareholder was retiring and it was to make room for the new leadership, or there was to resolve a dispute, that the company benefited from that share buyback? Really, really important, and you need to be able to demonstrate that. The exiting shareholders' interest must reduce by at least 25% in the issued share capital as a result of the share buyback. There also can't be a connection with or an association with the company after the buyback. And what that means is that the exiting shareholder or their associate, so for example a spouse, don't own any more than 30% of the share capital voting power after the buyback. The shares must have been owned for at least 5 years by the exiting shareholder before the buyback. And the buyback must be shown that it is for bona fide commercial reasons, and that ties in with that first benefit of trade test. The departing shareholder also needs to be Irish tax resident in the year that the buyback takes place. So where these conditions are met, and they are quite detailed, just to go down through them all, it will qualify as capital. So potentially then you look to see whether the retirement relief conditions are met and or the entrepreneur relief conditions are met. That's how the share buyback can be done very tax efficiently. But if you fall outside of any of those initial conditions, you're into income tax, and that's not a good space from a tax perspective. Now this is quite a busy slide, so I'm just going to, because I'm conscious of time as well, I'm just going to run down through it It's the difference between selling shares and selling assets and why you may do one over the other. And typically it will come down to the buyer, or this is looking at a share sales scenario, or companies or a business sales scenario, where you would have a buyer wanting to do one thing, a seller wanting to do maybe a different thing, and it's whoever really has the power, I suppose, to drive through what they want. So the considerations that would come into play. So with a sales share, you're transferring the ownership of the entire company. Everything held within that company goes. All the assets, all the liabilities, all the staff, all the IP, it all goes with the share sale. With the asset sale, you can pick out certain assets that you want, and you know, as a purchaser, you can pick out bits and pieces or the aspects of it. If there's a company and you don't want all of it, you just want part of it, it can be that asset sale. For the seller, on the CGT side, it's more tax efficient to sell the shares. You know, you're into capital gains tax, you're just selling the asset, and hopefully you can get retirement relief or entrepreneur relief. With the asset sale, you've got two events for tax. You've got the company is going to pay tax on the sale of those assets, and then the ultimate shareholder is going to pay tax getting those funds out of the company. Stamp duty is going to be higher on the transfer of assets, and the rates of stamp duty have gone up over the last couple of years. So stamp duty is becoming a consideration, whereas in previous years it may not have. Trading losses, if they've arisen over the last number of years, they will go with the company in a share sale. They won't with an asset sale. Liabilities are often the reason that drives this. Where you might have a legacy company, a purchaser might say, look, we don't want to take on all of the legacy issues with the company, so we're not going to buy the shares, we're just going to buy certain assets. And that can be a driver. The goodwill will always go with the shares, because with a share sale, everything goes with the company, including the goodwill. Whereas with an asset sale, that may or may not be the case. The goodwill is a separate asset. So really, it comes down to the preference of the buyers and the sellers, and who really has the power to influence to get, you know, how they want the deal structured over the line. Holding companies then, so, you know, we put in holding company structures a lot. You know, they come up time and time again, and there's really, really good commercial reasons why you may have a holding company. They don't suit everybody, but in the right circumstances, they can be very effective. And really what it means is if you have your holding company owning your trading company, and your trading company is sold, then where this participation exemption applies, the sale proceeds, when the trading company is sold, the sale proceeds will go tax-free into the holding company. And the conditions they're okay, they're not too bad. The subsidiary of the holding company needs to be a trading company, and the holding company needs to own at least 5% of the share capital in the last 12 months, for 12 months in the last 2 years before the disposal. So that it can be a really good way. If you're happy that the sale proceeds don't go into your own back pocket, that they go into this holding company and that you could use them for further investment, it can be a really good way to do it, because those proceeds will go into that holding company tax-free. Where I suppose it doesn't work as well as if, as a shareholder selling a business, you need to access those sales proceeds for your own personal use. You're going to have to pay income tax taking those funds out of the holding company. So really the holding company comes into its own, where you can leave most of the proceeds in that holding company for further investment. So that in that way you don't need to take the funds out, and you're not going to be hit with the higher rate income tax on that extraction of the funds. So holding companies can be really good if you say you have a trading company, you've built up a lot of reserves, and you want to invest in other areas. You can use the funds in that trading company to fund other ventures, and you still, because they're going to be in separate companies, the other ventures, you're ring fencing your risk from your initial trading company. So again, just looking at transfers of family businesses, whether that is by a third-party sale or a succession plan, you're all the time trying to balance family dynamics with business needs. The use of family partnerships is something that comes up more and more now over the last number of years as the founders, the shareholders are looking to move on and they want to bring the next generation in, but they want to do it on a phased basis. And family partnerships is a very good option. Just at a very high level, what it allows you to do is transfer an interest in the business to the next generation, but as the shareholders, as the parents, retain the voting power and retain the control for a certain amount of time. And the idea is that the future growth accrues in the hands of the next generation. So the next generation get the value of the business at today's value, and it accrues in their hands going forward, while still allowing the parents to retain the voting power and the control. And it's always that balance between getting, where you want to do a family transfer, getting the family over to the next generation and minimising tax, but also not compromising the business by the children getting that control and voting power too early in the day. Parents can act as managing partners, so they have the voting power, but the children hold the beneficial ownership. And it would need to be put into a partnership agreement, and all of the terms and conditions set out in it. And importantly, in that agreement, you'd need to provide for contingencies like the retirement of the initial shareholders, their death, an untimely death, or the withdrawal of a partner where a partner leaves, and there's a change. So these are all the conditions and the contingencies that would need to be kept. And again, really important that all parties are involved in the conversations around the setup of this. Really, really important, that communication. Just finally then, a couple of very high-level case studies. We have, I suppose, typical scenarios that can come up. So we have a father, a mother, and a son own shares in the company. Each of the parents owns 40%. 40% for the father, 40% for the mother, 20% for the son. The son is involved in running the business. The father wants to leave by way of share buyback. Now, unfortunately, as that's structured, the father won't get the CGT treatment and that means he won't be able to claim retirement relief or entrepreneur relief because the wife is still there with her 40% shareholding, meaning that an associate of the exiting shareholder still has more than 30%. So that's where the shares would need to be realigned, maybe a transfer to the son well in advance of the share buyback to make sure that 30% association test is met at the time of the buyback. Another example then, finally, just a family partnership, just some food for thought. So say we have a case where Mary and John have sold a business and they've gotten €5 million in proceeds from selling their business, and they want to help out, their three children, their three adult children in this case. An idea potentially is that John could allocate $2 million into a family investment partnership and gift maybe 400,000, for example, to each of the three children. So that's going to use up a fair lot of the 5 million. The partnership then, if partnership is the partnership that's formed, the partnership as an entity in its own right could then borrow for their €1 million and use that to acquire investments. So those investments grow, and any income from them comes into the partnership. And as time goes on, say 15, 20 years later, you have Mary and John in their 70s, and they can transfer more over to the children, and the children have gotten it. And the values of those assets the children have already gotten them, and the value of them for 15 to 20 years at that point. So really efficient way, and it's also a good way to bring the younger generation in and have them become involved in the decision-making process, involved in that education piece, if you want, is really, really important. And a family partnership can be a good way to do it. So that's it from me. Thank you very much for your time and your attention, and I'll hand you over to Julie.
Thanks very much, Mairead. I hope now my slides are going to work because I have some nice diagrams for you. So I'm going to talk about exiting business, M&A, and then finally looking ahead to what may be coming down the tracks, which I'm not going to lie is the most interesting part of what I'm going to talk about. So in terms of exiting a business, which Mairead has already gone through, but I suppose just one kind of simple point to bring to the fore on this. So if you do have that holding company structure that Mairead talked about, so you have a holdco owning the trading company, and perhaps over the years you've done quite well and you had surplus profits, so you invested those in non-core assets, for example, property investments, and you may also have significant cash on your balance sheet. So I suppose, why would you consider a reorganisation before you look to pass that down to the next generation? It is because, I suppose, depending on how the values move of your trade versus those investment assets, which are your non-core assets inside in the group, that can actually, in a worst case scenario, eliminate qualifying for retirement relief or business relief. But even aside from that, it does skew the ratio in terms of retirement relief where you have those investment assets mixed up with your trading business. So it is actually worth separating them beforehand and doing some reorganisation around that, just so you're protected from the risk into the future. The other thing that Revenue do look at when I said about having maybe a lot of cash on your balance sheet is Revenue do look at what they call excess cash, and there's actually been a tax appeal commission case on it. So before you would do a transfer, you need to really robustly document why you need that cash and why you're holding it and why you need it for business purposes, basically. Moving on then to mergers and acquisitions, which might seem a bit unusual in the current climate, but we are actually doing an awful lot of due diligence at the moment, purchaser and vendor side. Now, whether deals will go ahead, I suppose, is another thing, but there are two issues here, and they're actually also areas of revenue focus, so it's worth, I suppose, bearing them in mind whether you're thinking about a sale or not. So employees versus self-employed contractors, and then closed company issues. So this is one of my lovely diagrams. So there was a case before the Supreme Court, Carson Midlands Limited, but better known as Domino's Pizza, and related to Domino's Pizza delivery drivers. And following the decision in that case, Revenue released new guidance in May last year, which set out this 5-step decision-making process as to basically how do you decide if somebody is an employee or if they're a self-employed contractor. And you could be sitting there going, well, why would I care? So I suppose the obligation is on the employer to operate payroll taxes correctly. And if you don't, in some cases, that's considered deliberate behaviour if you were to have a revenue intervention. So you're looking at penalties of between 10 and 100% if that's not done correctly. So if the classification isn't correct, so it's very important. So obviously, if somebody is your employee, you'd expect to be operating payroll taxes, whereas if they're a self-employed contractor, they should be filing their own income tax return, and it's as such kind of no concern of yours. But this framework has kind of 3 questions which are inside that little filter. So they're the filter questions. So is there a work wage bargain? So do you actually have a contract in place at all? Are you paying somebody to complete work? So for example, someone volunteering, they're not an employee because they don't get paid for that. Secondly, then it is about personal service. So where you have an employee, you would expect them to provide their own personal service, that they can't bring somebody else in to do their job, versus an independent contractor, they can outsource the work, they can get assistance to help them, etc. And then the third question is about control, which might sound a bit odd, but do you control kind of when, where, and how the work is done? Within reason, I suppose. So it is acknowledged that with skilled workers, you're not going to be deciding how they do their job every day, but do you have ultimate authority to decide what the deliverable is and when that is delivered? And then if you move through all those 3, and you say, yes, this person appears to be an employee, kind of, is there anything that gets them out of that? So is there anything in the legislative context that you need to think about, or in your dealings every day with that person? Does it make sense what you're saying, that when you've completed these questions, based on all the facts, are they an employee or are they an independent contractor? And as I say, it's very important to make that distinction, and Revenue do expect that more people will be brought into the net of being considered employees through following this decision-making framework which the Supreme Court outlined. Helpfully, They have given some guidance in that tax and duty manual, and they went through various sectors to say, look, what are typical scenarios in these sectors, and would these be considered employees or not? So I'm not going to go through all these, but we say the construction sector, for example, where you have someone like an electrician or a plasterer, they work for one company, they're basically told what to do, they turn up on the day, then they're likely to be considered an employee. In terms of the retail sector, I suppose they did flag that just because somebody is on a part-time or casual basis doesn't mean that they're not an employee, so that, till operators, fuel pump attendants, that type of thing, they tend to have very little control over how and when they do the work, and they would be under supervision, so they're likely to be considered employees. So as I say, if the point on this is if you do have individuals you're engaging with, it is worth reviewing the arrangements in place to make sure you're comfortable that they are independent contractors. The other point to note in this is, I suppose, Revenue have said that they will not look through corporate structures. So if you are dealing with a company, and even if that's a one-man band or one-woman band, that's fine. They won't look through the corporate to say that that person is an employee. Interestingly, in terms of employment law and or social protection, they're under different legislation, so they haven't necessarily said the same thing, that they won't look through companies in this type of scenario. Closed company provisions are another thing to bear in mind, I suppose, that we would look at during due diligence, but also Revenue have flagged that it is an area of focus for them. So what is a closed company? So it's basically a closely held company. So a company which is controlled by 5 or fewer shareholders, basically, or by the directors, no matter the number of them. And if you are in that scenario, which a lot of, I suppose, Irish family businesses would be, kind of what do you need to look out for? So there's just a couple of things. So are you paying expenses for shareholders or their associates, for example, for living accommodation? And then also loans are the other big point. So loans both to the company and from the company. So interest paid to directors will be treated as a distribution if it's beyond a certain limit. And I suppose, what does that mean? So the individual is potentially liable to income tax on it at their marginal rate, and then also the company doesn't get a tax deduction for it because it's treated as being a distribution of the company. And then also on the other side, I suppose, where you're making loans to shareholders or their associates, you're actually supposed to gross up the amount of the loan and pay income tax over to Revenue. I'm not going to dwell on surcharges too much, but they obviously do exist, and there is a 20% surcharge where a company doesn't distribute its rental or investment income within a certain time period. And also there is a closed service company surcharge which applies to professional services companies. So it can apply to the likes of engineers, auctioneers, quantity surveyors and that type of thing, where they derive the principal part of their income from professional services. And it's obviously costly if you don't comply with these provisions, so it's worth bearing them in mind. This is the more interesting part, if I want to put it that way. So looking ahead, so 2 things, auto-enrolment and potential tax reform. So auto-enrolment, as you're probably all aware, was supposed to come into force on the 30th of September, and then Jack Chambers at the weekend has flagged that it will be a couple of months past that. So it remains to be seen when exactly it comes into force, but I suppose the interesting point here maybe to watch is in terms of anyone who might be in the bracket of watching their standard fund threshold. So that's currently €2 million, but it's due to increase over the coming years. But if they have stopped making pension contributions, I suppose, to manage their standard fund threshold, they will be automatically enrolled because basically the system will flag that they're not making pension contributions and that their employer isn't making pension contributions. So what they need to bear in mind is that they need to opt out within the window, which is after 6 months of auto-enrolment and before month 8. So in month 7 or month 8 after auto-enrolment, they need to opt out if they don't want their standard fund threshold to be impacted, because the kind of auto-enrolment pension does count towards that threshold. This is probably the more interesting point, and I'm also conscious, I suppose I didn't hear John's speech earlier, but when I thought about navigating tomorrow, to be honest, potential tax reform is what did come to my mind. And on the left there are our corporation tax receipts since 1984 and their percentage of overall tax. So the bar chart is the corporation tax and the line graph is the total tax receipts. So they're obviously making up an increasing portion of that number, but also, as very well publicised, they're extremely highly concentrated. So the top 10 companies, and that's just companies, not even groups, paid 52% of corporation tax in 2023. And that's obviously a high risk in terms of whether they're exposed to tariffs or just their profitability is obviously exposed to a global downturn in the economy. So being completely speculative, where might we go? So what I have on screen, that little donut, is actually the 2024 headline tax receipts. And obviously corporation tax is leading the way, but that does have the benefit of the Apple money in there. Traditionally, income tax is the highest earning tax head, and corporation tax and VAT would be behind that. But what I wanted to focus on for a minute is CGT and CAT. They're on the right, which I've highlighted in pink because they're so small you could hardly see them. So they make up 3% of tax revenues for 2024. So I suppose when I was thinking about this, if you look across to the UK, what they have done is they have restricted their equivalent agricultural and business relief from April 2026 onwards. So where the value is over 1 million sterling, you only get 50% of the relief. And we have looked to the UK for inspiration on tax policy in the past, so I suppose it wouldn't be unexpected if we were to go there. What I also, I suppose, dug out was the Commission on Taxation report from 2022, which had various recommendations, I think 161 recommendations in total, but in terms of its relevance for business people in the room, they did recommend the curtailment of business relief and retirement relief, and we have seen some of that in terms of what Marie has said, in that you have the 12-year holding period now for businesses over 10 million euro. And I suppose I wouldn't be surprised if they did something similar in terms of business relief, and that was one of the recommendations in the report, that you would curtail the value which could qualify, and also that you would require active participation of the beneficiary in the actual business they're being gifted or inheriting. The other thing the Commission looked at was in terms of, I suppose, harnessing the huge wealth that is held within housing in this country in terms of people's own personal dwellings. So at the moment there's principal private residence relief. So on a disposal of your main sole or main residence, you essentially get a full tax exemption from capital gains tax, which then you can obviously go off and reinvest in a new house or home and onwards like that. But their concern, I suppose, is that was driving the property market potentially, and should that relief be curtailed? Now, they didn't say exactly how that would be done, but would you look at a lower rate of CGT applying to your PPR, perhaps as a way to manage that and to get some tax take from it? And I suppose kind of taking everything into the mix and the global economic uncertainty, to put it mildly, if I was somebody that was thinking of doing a transfer to the next generation, I would probably be doing it sooner rather than later, within reason, in that, as Marie said, you can do a partial transfer. It's not that you have to give up everything straight away, but I would be surprised if the reliefs that are there at the moment existed in their current form in 5 years, just because of where we're going and where we're going to have to get tax revenues from. So on that cheerful note, we'll take any questions you have from the floor. Thank you very much.
I have a question for Julie. I was just wondering, do you see any positives in terms of potential tax reforms for SMEs?
Yeah, sorry, I'm conscious we've been very negative. People will be going out of here saying, God, the world is ending. Oh, sorry. Sorry. Okay, sorry. I am conscious that we've been very negative, and it's like the world is ending. But I suppose through, we'll say KPMG make a budget submission, and the Cork Chamber obviously make a budget submission, and through those we have been pushing for reform in terms of SMEs in particular. So it's a very hard environment to operate in. There's huge regulation, huge tax complexity. One of the things we had looked for was even something as simple as a consolidated tax return. Like, why can't you just file a group tax return instead of each single entity, which sounds very simple. But I suppose beyond that, and even I think Helen mentioned it earlier, in terms of funding for businesses, there's huge wealth on deposit in Ireland, and we need to try to free up some of that. And she talked about EIIS, which is has a lot of onerous conditions, and I think is not claimed as much as it could be. So it's trying to make things like that, I think, workable in terms of tax policy, and just make it a slightly easier environment to operate in, because the challenges are going to come from every direction. So why can't we manage some of it domestically and kind of do what we can on that?
Thank you so much to Julie and Mairead. That was excellent, very informative. So, and thank you to everyone. I'll pass you over to Paul now for the closing address. Thanks, Millian.
Ladies and gentlemen, I think you'll agree it was a very informative and good discussion here today. So I'd like to put your hands together for everyone involved. A morning like this couldn't be put together without the hard work and dedication of certain people. First of all, I'd like to thank my team at Paul O'Donovan & Associates for their hard work, professionalism and dedication. To Jackie Walsh and Liz McCarthy, the office manager, who without their help would not be able to address this meeting today. Cy Warren, for her hard work, dedication throughout the last couple of weeks, has been fantastic. To Paul Murphy of VBC for helping us put the presentation together, and to the speakers then, everyone concerned, and to Brendan facilitating the finance speak earlier on in the day. To the hotel for putting the room, and unfortunately the slides didn't work as well as we anticipated, but as John Finn did correctly state, they will be available for distribution, and you can get onto the office and we'll be able to facilitate anyone that wants them. And finally, to yourselves, thank you very much for attending here today. Without your attendance, obviously, today wouldn't have run as smooth, and I hope you got something out of it. So thank you very much.